to. As time went by, I even tried to start selling options in the mid 90s, and I borrowed a lot of money to do it. And I
Wow,
was
look
lucky
at
to
that
leave
epic
that
dragon.
alive.
It's like something straight out of a
Because you have
legendary
to
tale. What's your plan to tackle
You
expiring
say
breath?
borrow money to trade options.
Yes, I thought, being that I know everything, why not try it? You know, I wish I could remember the seminar that I watched on. I watched the guy give. I wish I could remember it. I think it was a British fella. I wish I could remember his name because he really deserves to have credit for it. He said, if you know you're right about the price of this security, you need to just go all in.
Oh my God.
And he was talking about taking your risk controls off, right? That's what he was getting at. He said if you know you're not going to lose money, why don't you go all in? And I was like, yeah, he's right. And to a novice trader, they'll do that, right?
I see it. How did you borrow? Who did you borrow the money from?
I borrowed it from credit cards.
Oh, wow.
And I would not recommend people do it. I avoid debt now like cancer, if possible.
And so what were some of these early experiences with options like for you?
Well, the first thing I had to deal with was I was dealing with Waterhouse Securities, and they had a lot of stringent requirements that you had. The reason why I was borrowing money is because I wanted to reach the level where I could get to, well, I think it was level 5 options trading, where, level 1 is just your basic buy and selling, puts and calls. Level 2 gives you something else. But level 5 gives you everything, naked selling and the whole 9 yards, the whole Megillah, so to speak. But in order to get to level 5, you have to, for one thing, you're going to have to go tongue in cheek on your experience when you don't have any, because they want you to have experience. Well, if you don't have level 5, obviously you don't have experience selling options. And another thing that you had to have was a high capital requirement. You'd have to have like $25,000, I think, back then in the account. That was a mountain of money to me back then.
Interesting. So what attracted you to go for a level 5 option account so early on?
I thought, and when you talk about a good quote, this is another good quote, and this is another novice mistake. I was under the impression that, hey, this option thing is going to be easy. All I have to do is sell options far enough away from the current market price, and I'll be safe. And option traders make that mistake a lot, I believe, as far as option sellers. And I don't care what stripe they come in. I don't care if they're doing selling put options, cash secured puts, or wheeling stocks. I don't care what stripe they come in. They have a misconception about probability and edge. Probability and edge are two completely different concepts. You can lose a whole lot of money thinking that you have very high probability. I had a pushed move a few weeks. Right now, my main focus now is I'm selling credit spreads on the SPX right now. You get some interest rate favor, and you get some 1040, 1256 gains from straddles and losses on tax returns by dealing with the SPX contract. And I had an option last week that I sold. I think I sold that option for like 60 cents. And we had that big pressing day. And today is September the 8th, 2023. If anyone wants to go back and look at it, go back and look a week back. You had a big up day in there, a big green candle on that chart. That option that I was short went in the money by $30. And I think that's correct. I think it was like $29 or something like that. And if I would not have had loss control, and I still overran my loss parameters a little bit, and you can see that in my equity curve on that day. And I was, I overran my loss parameters a little bit, but had I not gotten out, if I would have frozen like a deer in the headlights on that trade, I would have I would have given back a significant amount, because I think it was a 10 lot. I know it was a 10 lot because I was trading 10 lots at that moment. And that would have been they would have took about $30,000 on that if I wouldn't have, because the credit the long part of the spread was way out of the money. It was like 50, 60 points away. So it didn't get hit, but I would have ate every bit of that move in the money that it went.
Yeah, I'd like to go back to when you first got into options, and you immediately wanted to jump to level 5 trading of options. And this is before. Is this before having much experience with just going straight along calls and puts with like most?
I had never bought an option in my life. I don't. Well, no, I've got to take that back. Yes, I did. I bought. I was looking for a trend trade in the banking sector one day, and I saw Citibank was moving up, and I bought a 10 lot, and I lost every bit of it. So yes, I had bought some options before that, and I had bought some one time in the flash crash on the S&P 500. It's the same flash crash that had destroyed Victor Niederhofer when he blew up the first time. He had a black pigeon went swimming by and took him out. And but on that day, just on a whim, and I was going to cash machines around town, like a crack addict, right?
Well, this is to borrow more money to
no, not to borrow money. This is money I had in my checking account. I think that because I'm always a saver, right? I'm always a saver, and I've always fed the markets with what I say. So anyway, I'm going around town at a cash machine, going to get $500 here, where I can get it from, or from a teller, because I needed to get the money quickly, because I had a stockbroker here in town, and I wanted to be in his office first thing in the morning. And this was the day before the flash crash. I just had an inkling that the thing was going to crash.
Is this 2010?
No, this is not 2010. This was 1997. You have to go way back. I think it was 97, October 1990s. I can't remember the exact day. I've got a picture on my phone of where Victor Niederhofer made his mistake. But the options that he was short, because he's an infamous theta trader, and he did blow up that hedge fund. I felt sorry for him, really did, because I have a lot of respect for him. I think he's a very knowledgeable trader, even though he did blow up. But I've got a stack of books right here on my left over here. I can name names.
I see.
Plenty of people.
Was your interest in getting a level 5 account prior to having much experience trading options?
Yes.
Was this influenced? Do you have like a gambling nature inside of you? Do you like playing risky?
Sometimes I wonder about that, and I have thought about that a lot. Yeah. Sometimes I do think I have some gambling issues, and trying to get that under control. And I think it shows up. The gambling issue shows up in hope, right? Because you can picture that person at the slot machine just hoping that the wheel comes up right, or at the roulette wheel. And I have been in that position before, and it usually doesn't work out. And what you need to have, and this is some advice for people that are trying to make it in this game, you have got to have loss controls in there. Once you start running out on your loss controls, you have got to get out of the trade. And I know it hurts. It hurt me anyway. It still hurts me today. I hate it when I have to take a loss.
Right. So did you have, in those early days, say in the 90s, did you have any kind of loss controls? Was it just like a mental stop loss or what?
No loss controls. Didn't have any concept of it.
Mm-hmm.
Did not have any concept of it. And I was, and like I say, I was selling options against the company, iOmega.
Oh, iOmega, I remember them.
Yeah, and they finally went bankrupt, right?
Mm-hmm.
But I had built up a substantial short call position, and that's back in the days when they traded in what they call teenies, right? 16ths of a point. They call them teenies. And I would say I finally found a broker that would take my account, took my $25,000, and it was the most stressful thing I'd ever been in my life. I mean, if iOmega had a turned around and shot back up because I was selling calls on iOmega, if it would have shot back up, it would have bankrupted me.
Oh, wow. Did you, were you able to follow the implied volatility to help you pick stocks to sell options on, or did that exist back then?
Didn't even know what it was. I'm sure it existed, and I'm sure that the major brokerages did it. For their proprietary trading desk and all that stuff. They're running those high level algorithms. I'm sure that they use the IV ranks, but I didn't even know what it was. If you asked me what implied volatility was, I couldn't have given you an answer. I did get a lot of trading experience, so. But as far as what happened to the $25,000, I think I lost a couple $1,000. And I can remember being at an amusement park, and I was thinking about what these options were doing to me while I'm down here. And I got back home, and I closed the account. I took the money out, and I paid everything back. And that wasn't going to work.
Oh, so you paid back your debts? I mean,
Oh yeah. I've never had to go bankruptcy. I've never had to go into bankruptcy or anything like that. I've always paid everything back. It has been a burden at times, but I have always paid everything back.
During the 90s, was most of your trading involved options, or did you also trade
early 90s? It was early 90s. It was option. Early 90s, it was just straight bets on stocks, and then later 90s, it became options, and then I migrated in early 2000 to a job that paid me better. And I was still giving money back to the markets. And I started to do a lot of research online, and I ran across books. And one of the best books I've ever read about the market was the Jack Schwager book, The Market Wizards. A couple of interviews in there really changed my whole perspective of markets. And that was the Michael Marcus interview and the Ed Seykota the Wise. Those two interviews, and there's a bunch of other good ones in there. Marty Schwartz had a very good interview, and the Paul Tudor Jones, and there's a bunch of others. Too many to mention.
What were some of the key takeaways that you got from the Market Wizards book, and what changes did you implement in your trading?
Okay, I still had a problem with loss control, right? But some of the things that I really enjoyed about the book was you're going to have to find a methodology that fits you. And you're going to have to make it your own. And I could have really benefited in my early years instead of feeding money to the markets. What I really needed was a trading mentor. And one of the things that they didn't really talk about in the book, but almost every great trader in there had a trading mentor, one way, shape, form, or another, that they mentioned in that book. Michael Marcus, he was basically mentored, I think what he said, by Ed Seykota. Ed Seykota, he was just a genius, I guess, but I think he was mentored by, he mentioned it, but I can't remember the name. It may have been Amos Hofstadter or someone like that, or it may have been, I can't remember who it was now. But if you look at what these people went through and what they did, they were trained to think and behave as traders and not people coming into the marketplace with the idea and just trying to execute on it.
Did you know anyone during all these years who traded, any family or friends who you could talk to?
No, I did not. And generally, the general public, they're not going to be very supportive of you trying to do something like this. My dad was always supportive of it. And in the later years, he really became a staunch ally for me because he had seen some of my capabilities. And but he didn't know a whole lot about markets. And this is another good quote that you can get from me. If we can argue that the market is the sum of the psychology of its individual participants, well, then the market itself has its own psychology, and it is on display in those graphs and charts that we see. Now, I know you'll get a lot of ridicule from the fundamentalists. Jim Rogers he's going to bow up at that. It'll make his bow tie spin.
You quoted us earlier. You said that the market is the most insidious sociopath on earth.
Yes,
Care to elaborate?
it is, because what do we do as traders? What are we doing every day as traders? We're trying to take money from other traders. So if the market, now we've established that it has its own psychology, the market will try to manipulate you as a sociopath would to make what Mark Douglas would call trading errors. And it will try to make you hang on to those trading errors as long as possible to try to take as much money from you as possible. So it does have the traits of sociopathic behavior. Now, what stops a sociopath in your life? If you run across one in your life, in a relationship or something like that, it stops when you cut it off. It's a choice that you have to make. But people get so vested into it that they run way past their loss parameters, and that's in life and it's in the markets too.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including zero commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So would you characterize your early trading in the 1990s and maybe early 2000s after the advent of the internet as a time period of what, exploration,
Right,
gambling,
learning. I was learning about the markets, and I had just enough information going into the financial crisis to make a fortune and give it all back. And
please tell us how did this happen?
Well, I went in and I had accumulated an account. I won't get into the details, but the money that I had saved, and this money became freed up to me, and it was in an IRA. And I know I'm going to get a lot of ridicule because I've had to explain this before. People tell you that you can't trade commodities in IRAs, but you can. Interactive brokers, and I'm not trying to plug them, but that's the brokerage that I use. When you establish an IRA with them, it's established in trust, and it allows you to trade more exotic instruments. And back in those days, you didn't have these daggone exposure fees. So, man, you could really lever it up, right? It doesn't really cost you nothing but the commission. But when crude oil started peaking, went into a parabolic, I felt like that crude oil was going to probably collapse.
What time frame are we talking about?
We're talking 2007.
Okay,
When
2007. Okay, so now you're trading with your IRA account, correct?
I'm trading with IRA account, and I had I had more than $100,000 in it,
Hmm.
and the loss pattern initially showed up because I got too early on the parabolic, and I was shorting soybeans, I was shorting crude oil, and I was shorting copper, and I can remember. And I think it was 2007. I think I have to go back and look at the chart. If I saw the chart, I could tell you exactly the day when it peaked in there. Crude oil peaked at like around $148 a barrel.
Yeah, I think that was in the summer of 2008, just before
Uh, there we
just before
go.
the crash.
So that would be it then. That would be the time frame. 2008. The IRA I had a little bit before that, right? So I was trying to catch this top in crude oil, but when you're trying to catch the top in a parabolic, it's very dangerous because parabolics move. Look at it's a mathematics things, right? Parabolics move fastest at the end. I think I had 140 some $1,000 in that account. By the time crude oil had finally peaked, and man, this got me to doing some drinking and thinking. I had whittled that account down to $75,000. So, I'm talking about IRA, right? This is money you've been saving for the past 18 years here, and you've gone through half of it in 90 days. But the trade size was too large. It did finally work out in my favor because I eventually caught the crude oil market just right, and it rolled over. And by the time it broke down below $95 a barrel, my 70 some $1,000 account was worth over $1 million.
Wow, and that's a very short period of time, right? I
Very
mean,
short period of time. We're talking weeks.
mhm.
And it came in chunks like this. I can remember my dad one day. He would talk to me about markets every now and then, and he asked me, "How'd you do today?" And I told him, I said, "I did all right today. I made $72,000 in one day." He froze, rooted to the spot. He couldn't believe that I had made that much money in one day.
So reflecting back at that time, based on kind of what you were using, the strategies and what have you, do you attribute that to just luck, or was there some level of skill in that? And if so,
It was some
what was it?
skill, and it was some skill, and I've got talking about the psychology of it, and this kind of branches off in here. Uh, I read a book by Robert Prechter, and Prechter is a notorious deflationist. And I read that book in the mid 90s. It was at the crest of the tidal wave. It's a decent book to read, but you shouldn't trade based on it. And you should never let a hyperinflationist, which is going to be the bullish case, or the hyperdeflationist, which is going to be the bearish case, influence your trading. That is very difficult for me to break away from because you're trying to break away from the very fabric of who you are. You know, like Peter Schiff, he's a hyperinflationist. Peter Schiff would
Mhm.
never short oil, I don't think.
Right.
He's an avid hyperinflationist. But like Jesse Livermore, I guess it was Jesse Livermore was talking about it in his book. He talked about there's the bullish side, and there's the bearish side, and then there's the right side. You want to
Uh-huh.
be on the right side.
So going back to your crude oil win, could you explain a little bit the skill aspect that you felt in
A
that trade?
trend following model when I was looking for the trend to break. And I also had seen enough markets go into parabolics. I know what's going to happen to a parabolic. I had a guy one time talking to me. He dealt in cows, and I was heavy in commodities back then. And we're in a rural area here. There's a bunch of guys around here that deal with cattle and stuff. Well, they had a drought out west, and it decimated the cattle population. It's been years ago. This was after the collapse in 2008 and 9. And I told him, I said, look, that cattle market is in a parabolic. And I started pulling up charts of parabolics. I said, one parabolic after another. I said, you know what happened to every one of these parabolics? Here's a cotton parabolic where it went up to like, I think almost $2 a pound. Guess where it went to? It went back to where it started from.
Just curious, and what are some of the indicators that a parabolic is very near its end? I mean, have you found any methodologies to,
You never know when a bubble is going to burst. You never know. You never know how far it can go because oil set up before it finally did collapse in that 2008 collapse. It had a parabolic, and then it had a retrenchment from a parabolic that like went up into like the 70s or 80s, and then it consolidated. If you see a consolidation and it's very shallow and it starts to break back to the upside, you know you're probably going to have another leg to the parabolic, right? Now, what's someone who thought oil was going to collapse from that? I guess it was in the mid 80s back then. I'm trying to remember this from memory, from that price, and it actually got down maybe into the mid 60s, and they've been shorting it along the way, and they get stuck in that line of thinking. Well, they blew that account up when it came into the next leg of the parabolic. You see what I'm getting at?
Yeah. So when you were having your big wins with the crude oil, what happened? Where did your account top out at? And what time frame are we talking? What year are we talking about?
By January 2009, I had it over 3.188 million.
Wow. So this is so what were you shorting? You were shorting oil, were you shorting
crude oil,
stocks?
copper, and it was a ludicrous thing for me to do. I was also trying to short the treasury bond, but I had enough knowledge that when it breaks out, and I don't know if you can remember that market, but treasury bonds went into a parabolic during that time, and they skyrocketed. I can remember the treasury bond market. I was shorted at 119 on that treasury bond, and it went all the way up to 164, but I got out when it broke out of a base that it had made. I wish I'd have went long that market. I could have really made a killing there. The problem was I still had a lot of weakness in me. I was still, and I can remember Mark Douglas. He talked about a trader that he was dealing with, and he talked about this guy. And then this is outside the bond market, right? This is kind of like the book at what Prechter's book did to me. And I'm not blaming Prechter. All the flaws that I've ever had with trading, they're mine. They are mine. I'm not trying to blame anyone or cast blame, anything of that nature. But Mark Douglas talked about this guy who had made $6 million. He goes on vacation. It's in the early 90s. He takes a book with him that talks about how the U.S. economy is going to go into inflation and how the bond market's going to crash. And this guy, he comes back, goes to the Chicago Board of Trade down wherever to the bond pit down there, and he starts shorting treasury bonds like crazy. And he takes a $6 million account and he decimates it down to $2 million. This book influenced him to do this, and his wife had to call Mark Douglas. Didn't even know who he was, but she knew that her husband was kind of being taught by him. He had given up on the guy had given up on Mark Douglas, and she told him, "Please come help my husband, because if you don't, we're going to lose our house."
Right. So when you got your account up to about $3 million, did you think of like, hey, I've got this down, maybe I should just quit my job, or maybe even quit trading and just retire?
I should have took it all out, put it in an IRA, and just made interest. And well, actually, I should have just went long the market. And it's very evident. You could have drew a trend line on the S&P 500 from the top of the market right down into the trough where it bottomed out into the mid 660s. You could have gone long the market there, and the 3 million would have turned into 30 million probably, if the way I was trading.
But when you got up to 3 million, what were your thoughts then? Were you at that time? Did you think, okay, I want to quit my job, or I'm going to quit my job, and
No.
and I've succeeded, I'm successful?
I was having such massive equity swings. I knew, and I was at the Ford dealership in Raleigh, and I was talking to a car dealer over there, and I told him, I said, I know what my problem is. I said, I am married to a deflationist slant. And I said, I know the risk if this market turns around and starts to go back up, that it could decimate me. I know that is out there. I foretold my own doom. But I got to say, I did. I had a mortgage at the time. I had some other things. When I made all that money, I took that 3.1 million I'm telling you about. That's after I took a $500,000 out, and I paid every scrap of debt. I paid some of my dad's debt off. I paid some of my debt off. All the debt was basically gone. On my end, everything was gone. So it did free me up in many ways. I still feel the after effects of that right now, because
I,
being debt free was a big leg up for me.
I see. So January 2009, you're at your peak. And what did you do from January 2009 onward? Did you stick with the commodity short, thinking that more deflation's going to happen?
I was waiting for I did catch a long trade in there right off the bottom, and my account actually probably peaked in March, and because I caught a long trade. I think after oil had gone down into the mid 30s, and I was trading at the time like 250,000 barrels at the time, a lot,
Wow.
way too much, and that's what was giving me these huge equity swings. Like I can remember when I broke $1 million. It wasn't 3 days later, I was back down to 800,000. So I still had no respect for loss control. And I'm like a recovering alcoholic on that. Yes, I'm a recovering lossaholic.
So, question, during this time, you had a full-time job. Did
Yes.
you feel that because you had the full-time job to rely on for regular income, that you could get reckless in the markets? What was your attitude?
You know what? You probably have hit on something that was underlying under there. You always felt like you had something you could go home to, right? Yeah, and I think that was part of it too. But if I knew that I knew I had that deflationist slant, and it was quite obvious the Federal Reserve was pumping money into the system at a scale unseen in modern in history, and the deflation, of course, got stopped. But I still have that inkling that this economy could deflate. I still feel it right now, but I don't trade based on it, and I would recommend no one trade on it. You can use a 10-day moving average to get you out of trouble. If the market's above the 10-day average, just stay long. If it's below the 10-day average, just stay short. That'll get you out of 99% of all the problems.
So what happened with your account after you peaked in 2009? What did you continue to trade same?
I continued to trade, and I whittled it down a little bit at the time, like $50,000 a day here, $50,000 there. And I can remember one month I lost $1 million in a month. It's about $50,000 a day, 20 trading days in a month, and the psychological impact.
The dopamine
I'm trying not to be, but I'm trying to figure out how to get to consistency and have a consistent income from it. I don't from it. I don't necessarily. And Mark Douglas called it a boom bust era, right? You're in this boom. That's what I was. I was in a boom bust era. That's what it was. I didn't have the right type of tutelage to really deal with what I was dealing with. And you really need a good mentor, and you probably really need a good coach along the way. Hey, somebody that says, "Hey, look, you're getting off the foul line here. You need to get back in line."
So it seems clear that you have the talent to make the money through trading. But how does one keep it?
How do you keep it? You've got to have strict loss controls, and you cannot marry yourself to the idea that a market is going to go up or that a market is going to go down. A market can go either way. It's just so happens that you landed on the right side of probability. And there's a fellow by the name of Randy Howell, who's someone we might consider interviewing. He talks about that, and he said, and he's. I got to say something about losses a point that he brought up. Our minds are not adapt to trading. And I've got to kind of agree with that. He said, because we come from an evolutionary background where losing cost you your life. He said, if you would go back and fight back to the caveman days, and you had caveman there with his spear, and he's fighting a saber-toothed tiger, you're going to fight that saber-toothed tiger till your spear breaks, till you're throwing sticks and stones at it, till you're throwing sand in its face. Because if you lose that battle, you're going to lose your life. And the sand that you're throwing into the face of the market is your equity curve. And you can easily step back and step away. When your loss point gets to a certain point, you need to step back and step away, and you need to have the discipline to reevaluate what you are doing.
You've mentioned earlier when we talked with you that more to pull away. Could you go into more about what are these psychological traps that even someone like Jesse Livermore couldn't pull away from?
Or anticipation contagion is what they called it. I can imagine what he was feeling when the S&P 500, that it was going to make you take the loss because your blood was going to carry it there. You wouldn't pull sitting there and you're dealing with millions of dollars like he was, and it can cause devastation in your account.
What are you able to share that you felt that you had the legs taken out from under
model? I believe that to have an edge in the market, you have to have some type of trend following model, because price is what's going to pay you, and you have to have and I like pattern recognition. Now I know the fundamentalists, they're not going to agree with that. They're not going to accept that. But from a technical standpoint, from a standpoint that I like to deal with the market, I like to look at a trend following method, and I like to look at patterns in the market, like, triangles, head and shoulders patterns, breakouts, breakdowns, flag formations. These type of things are very important. But what's going to really keep you out of water, though, is loss control. And I call it puking positions up. Like right now, I'm getting a little bit older. I can't go out there and blow myself up like I did before. And I've come close in the past few years. But in the past year and a half, I have really started to work on this, and I've compressed it down. And you can see it in my equity curve. It still has some sharp drops in it at times. I can think of one in the past year where it got out of control too much, and I puked positions up. Well, we'll use a more polite term. We'll call it coughing positions up.
Yeah. Could you go more in depth of what is your loss control? Can you break it down for us?
Look, if I see a loss right now on the account of, say, $1,000, I start to think, we're getting into the red zone here.
I see. What is that percentage wise? Like what percent drop would that equate to?
It's going to be like close to maybe 1/3%, maybe a little less than 1/3%.
Okay.
But I would not take the loss at that point. Usually I don't. I have done it depending on what the pattern is, but the market's not going to let you out free, right? When a pattern starts to break against you, it's going to show up quick in those prices. Like right now, you might be down $500. Okay, and we get ready to break out of this triangle pattern. Well, you're not the only person in the world seeing this. Every market participant out there sees it. They're not going to let you off the hook for free. They're going to take some of your hide when you go.
So after peaking then in the early 2009 with your account, what happened over the next year or so?
Well, I'd say over the next 5 or 6 years, I really did not trade a whole lot. I always kept my trading account. I kept watching markets. But I told my dad one day, I said, look, I'm going to start building this trading account back up. I want to try this option writing system that I've been working on. I said, I know it's not a loss-free nirvana, but I want to start to try to apply more rigid loss controls. And I had some periods in there where I had some rather steep drawdowns in there also, because the market, that 4-letter cuss word in the market of hope, would still creep in there for some reason. And I think that Randy Howell had said it the best when he talked about his saber-tooth tiger. I could not let go of a trade. As long as I'm still in the trade, I still have a chance to make money. And that has been a problem. But over the past few years, I have been able to kind of quail that in quite a bit. And I think I sent you a picture of the equity curve for the past year or so. And you can see some drops in there, right? And you can see one in there where it almost got out of control. But you asked me about the control limit. If I see a 1% loss in a day, I'm gonna cough the position up. I can't stand it anymore. I can't go through that trauma like that.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So what was your position sizing like? Were you spread out among many positions, or did you have highly concentrated positions?
SPX only, and I could tell you, like right now, I can look at the account right now, and I can tell you that I've only deployed little more than a third of the account of total equity. I just looked it up. So I've only got a third of the account deployed in these spreads right now. And the only spreads I have on are the option spreads. And most of that's going to go away in 2 minutes because the market's getting ready to close. And of course, these options are going to expire on the close.
So from having that traumatic experience about 13 years ago or so, you took a break from trading. And then you got back in with a option writing strategy?
I've been doing that since 2015, and I've had a lot of success with it because let me tell you how low I was in this trading account. I was so low that I did not realize, because I don't keep up with the regulation, I did not realize that they had day trading limits. And I was like, what is a day trading limit? I've never heard of such a thing before. Well, I had my capital base had gotten that low that that I was running into those what is it, T3 day trading limits, which you can do 3. I don't know what it is, but you can't do so many in a week, right?
Right.
And I was that low, and I was and I made a workaround on that. I just went over and I traded the E-mini S&P 500 contract. That's 1/2 the SPX, right? It's 50 times the index. So I just went over to that market and traded those. And I was still going through the loss period, but I was cutting them off quicker. But I still had a few periods in there of 50% drawdowns. And I can say this about option sellers, like a put seller. I hear this all the time from people. It's a stock I don't mind owning, so I'm gonna sell a put against it, and I'm gonna just collect the cash. Well, what does that do? That insulates them from ever having to face that psychological weakness that I could be wrong and I could have a devastating loss. And I'm sure that there are people that were selling cash secured puts or wheeling on Enron that are still waiting to get back to even.
Yeah. So did you do much cash secured puts?
I would always do credit spreads. I would always hedge them. And now that I'm starting to put this 1% loss control in there, now sometimes the loss control is not going to be exactly 1%, because by the time the market gets to a point where I think it's going to break one way or the other, I've already overran my parameter, but I wanted to give it that much room because that's where the next resistance point is, right? Or the next support zone is. So you could run into it. But that's still a flaw too, isn't it? What that tells you is your sizing is wrong. you're trying to trade too large.
So your emotional experience throughout your trading career, has that forced you to lower the position size limits and then really adopt these strict loss control, parameters? How many times did you end up blowing up your accounts or coming close to blowing them up?
I only blew up in the early days when I only had $2,000. I mean, money just went. It just went right. I wouldn't consider it blowing up, but it like I'd take 2,000 and be down to 1,000, and it just I was undercapitalized. I was undercapitalized, and I was underknowledged. I and no respect for risk controls at all. And you needed to have more patience. You needed to have some patience to build up an account, and then you really need to have the right type of mentorship to tell you, hey, you can do a lot of damage to your finances here. And a lot of famous traders have gone through it. George Soros, I watched a video about him, and he was talking about some of his disasters. But how many times did I blow up? I just say the big mega account that I would consider that to be a blow up, because almost all the equity was gone, right? But that's the only time, and I hope that's the only time that I ever go through that. Now, since then, with the option selling program, I have had some 50% drawdowns where I let things get out of control. And one time I had a very big drawdown. It wasn't 50%, but I lost like $40,000. I was at work, and I was going into work, and the election had just taken place between Trump and Biden. And, it was contested in there. It takes a week for them to figure out who won. So we're going into Friday. Some of the states still haven't reported. I put a credit spread on the call side and a little bit on the put side. I'm more cautious on puts because I can still remember the flash crash. I went into work, and of course we're coming out of COVID, and it's been rumors going around for weeks on end about the vaccine. This one's got a vaccine, that don't have a vaccine. But on Monday morning at about 6:45 in the morning, the news drops, and these gave a lot of impetus to the market. The S&P 500 rocketed nearly 100 points in just a handful of minutes. From the time that I could walk up 3 flights of steps, I had lost over $40,000.
Wow.
Needless to say, I had a bad day at work. But that was my fault too, because over that night, like right now, if I look at my positions right now and I lose $1,000 in the overnight, that's probably a pretty good sign that the day is not going to go well, right? You're already down quite a bit overnight. You need to do some adjustment. And what I should have done back then, I should have turned it into a ratio spread, because with a move of that magnitude, I would have actually made money on it. And to add insult to injury, by the end of the day, the market had turned around and gone right back to where it was.
Quite often traders are more afraid of losses than they get, than the benefit than they get from gains, which is common among humans in general. Do you ever felt that your excitement for potential gains outweighed your fear of losses?
I don't know if I ever really got excited about a potential gain, but it was kind of like a scientific experiment, to be quite honest with you. And let's see what happens. But I do wish that I would have applied more loss control parameters to it, but because I would marry to my ideas, right? And I noticed something too I would do in those days too. I would go data mining, go try to find articles that would support my position. This is all rubbish. This is all rubbish. You're in chat rooms talking to people about this position. This is all rubbish. The only thing that's going to save you is a loss control parameter. That is the only thing that will save you. Do not let your losses run out of control.
After you experience these losses and then you tell yourself, I got to have loss control, and intellectually you get into that. But later on, once you get into that losing position in the future, do you tend to rationalize it, say, oh, well, this time it's different, or you come up with all kinds of reasons why, or you get swept up in the emotions of the moment and you forget the rational arguments that you made some time prior to about loss control?
You mean like the deer in the headlights?
Yeah, like a deer in the headlights. Exactly.
You're overwhelmed. Your sensory perception has become overwhelmed because you can't believe that you're staring at that loss again. I have felt it, and I think well, I'll just give it a few more ticks. I have felt that many times, and it usually and I've done it, and it worked out. But that's a trading error. That is a trading error when you do that. You're already overrunning your loss parameters. You need to get out. That's what you need to do. And you really need to get out before you really even get close to hitting your loss parameters, especially if you're trading when you start to cut your size back, because now it's going to take you that much longer to get back to get your underwater curve healed, right? Because you don't have the size anymore. And another error would be, well, doubling down on the next one. And I haven't done that very often, but I have added to losers in the past, and I don't do that anymore either. But that's another story.
You shared with us your performance on Fun Seater, and you got up fairly high up there. You were in the top 30, which shows that you're doing quite well. Have you ever considered trading for a prop firm?
I've considered it, but I don't know if it would match my personality. I know that there are some good ones out there. I know SMB Capital is a good one. But you know what? You go to those prop firms and you look around there, all those guys are young, right?
Mm-hmm.
And but you notice you don't see very many old traders.
Well, you might have some things to teach them, perhaps.
They probably could teach me things, but what there are old traders and bold traders, but there are a few old bold traders. But a prop firm, I mean, I've never wanted to go on the internet and meet a prop challenge. I've seen that advertised a lot. I've never done anything like that. No.
Because just thinking that if you're trading with someone else's money, maybe the pressure that you get from losing money is not nearly as great, and maybe that could allow you to focus in on the merits of the trade.
I did manage some money for a friend of mine one time, and he passed away from cancer. And I told him, I said, look, his name was Philip. I said, look, Philip, and I didn't have the size that I've got now. Account was like 1/3, like 1/4 of what it is, less than a fourth. I said, look, I'll take you $20,000 and I'll put it in this account, and we'll write up a loan agreement. And if I make money with this on this account, I'll send the gains back to you, and I'll pay you a flat interest. And your gain will come from, if we make money, you'll get paid back really quickly. And I paid him the interest up front. And I said, and we did it one time, and halfway through it, he called me on the phone one day and he told me he had terminal cancer. And I said, wow, man, that really put the pressure on, because I want to get this money back to this man before something happens, right? It was $20,000. I paid him all the interest up front. And within 4 months, I had made enough money between working and the job that I paid every cent of it back. And if he was still living, I still believe that we would still be doing those same type of deals today. But I was paying him like 4% interest, which that's not much now, but interest rates then were 0. And I told him, I said, if we could turn it over 2 or 3 times in a year, you'll make 12, 15%, whatever it would come to. But that was a sad case. But that's the only time I ever really managed someone else. If someone had enough faith to invest in my system, because, you have somebody you're talking to. I was talking to him about the trading system all the time, and the modifications I was making and what I was trying to do.
Did you ever feel more pressure because you knew him and you didn't want him to have a loss?
I didn't want him to lose money, and that's why I didn't want him to be a 100% equity stake. And if I were to manage money for someone right now, I wouldn't take a fee unless I did make money. And that kind of ups the pressure too, though, doesn't it? But I just don't think you should. I just don't think you should take a fee unless you make money for someone.
Right.
But
Yeah. Sorry about your friend there. That's
yeah, but
yeah. So, how about your performance now, and how have you built yourself back up?
well, through consistently saving money, and my market performance has been much better the past few years. Last year was a decent year, and I'm up this year. I'm up nearly 6 figures this year.
Well, what does that translate to percentage?
I can look on here. 29% so far this year.
Oh, good. Is this you're doing credit spreads? Is that your main
Credit spreads? But look, credit spreads, you can take a credit spread and you can make it into a total directional bet, right? It depends on how far deep you could go deep into money and sell a credit spread. Like if you have a conviction that the market's going to drop, you could sell a deep into money call option, and that call will fade away in value as the market drops. But you have to have the conviction that it's going to do it. And of course, the closer you are to the money, you're going to have to adjust your size kind of in that. You don't want to overtrade because you're going to run into those loss controls very quickly. It can happen out of the money too, but
yeah. So since you're big into selling options, were you attracted to selling out of the money options on any of the very high volatility stocks that we saw, say, in the last 2 years when the VIX index went way up and some of the meme stocks with their crazy implied volatility?
I almost did credit spreads on the GameStop deal when it went parabolic because I felt like that parabolic was not going to hold. And it didn't hold, but my capital was tied up. Of course, you would never, when you're in the middle of a parabolic like GameStop was in, you would never want to do a credit spread and I'm talking about on the call side. I felt like the stock had topped out, and this was before the split. It was like $400 a share. I couldn't believe what I was seeing. And I believe you could sell $600 calls for like $50.
I remember those times. Yeah.
Yeah. But you definitely wouldn't want to do that naked, because if it got out of control, something like that could have collapsed the whole financial system. Because what will happen is these brokers and these market makers, it could destroy the firm. If somebody that's on the wrong side of it, it could destroy, and you could get into counterparty risk. It's hard to believe that something like GameStop could have took the whole country down, but it probably could have.
Well, yeah, that's kind of scary to reflect on.
I mean, if it were, I mean, there was an episode. Remember when crude oil went negative for that short period of time?
Yes. Mm-hmm.
Okay, Interactive Brokers had a client that thought that, hey, buying crude oil for a penny a barrel, that seems like a pretty good deal. And he bought 272 contracts, I believe was the number. I get so many numbers in my mind, I forget them sometimes. He bought 272 contracts, and in the overnight session, he had a $9 million loss.
Yeah, imagine taking delivery of that oil and having to store it somewhere. I hear that the oil storage was full back then.
Right, but the guy had like $80,000 in his account, and he lost $9 million. Well, suppose a whole lot of their clients would have thought oil was a great buy at a penny a barrel, and you would have had thousands and thousands and thousands of contracts. Something like that could collapse the whole financial system, because it would destroy the banks that are back into trades at the end of the day, and the broker's capital at the end of the day. But that's a theoretical thing.
Mm-hmm. So now that now that you're doing a better job with managing your risk, is there a way that you hold yourself accountable you have anyone to share your you know, any mentors or?
No, I don't have any mentors, and there's very few people that I can talk to. My dad, he passed away in 2021, and of course, this friend of mine that I had, he passed away, and those two were the two that I really kind of bounced ideas off of, and but no, it's a void really because most people are just not interested in this type of thing, and they're definitely not interested in it to the level that I am.
Well,
Most
you can join our Chat with Traders community, and we have many fellow traders that like to share what's going on in their trades, and then you can share as
Yeah,
well.
I have read a lot of them. I'm thinking about doing that actually, and the most people, and I do have people around me that trade, but you think that when you come up with your own ideas, you don't want to be. They call it data mining when you're looking to facts to support your case. Well, you don't want to be people mining either when you're looking for people to support your case.
Exactly.
And but you see how that could be similar though. How you could have people could have some animosity, I guess is the way to say it, because you don't agree with their position or you don't agree with what they're thinking.
Right. So it sounds like you're doing a pretty good job with loss control currently. Is that accurate?
I would say that's accurate, and it's very much accurate compared to my past trading to my past boom bust era, and it's the struggle to get to consistency, and it really is a struggle, and it's the most difficult thing I have ever done.
I see. And how did you get better? Did you do any journaling? Was it just a mental?
I've got a stack of papers over here next to me right now that when I started when I took some large losses, that I was starting to write them down and chart them and see where I made my mistake and where I let a market run against me too far. Because if you notice over the past few years, I call them left to right days. We've had a lot of days in here where you've had major moves on the S&P 500 where it moves 70, 80 points in a day, and it moves from the left side of that chart to the right side of that chart, and it has very little reprieve in there. It's almost a straight up line. It doesn't give you any chance to get out. Because when it's moving against you like that, what do you want? You want it to take a step back, and maybe that'll give you your chance to get out. You just need to get out when I hear people say you need to turn the P&L off. I leave the P&L alone because if the P&L gets too red, I got to go.
Mm-hmm. So you keep track of your P&L. I
watch the P&L, and one of the reasons I do it is because it's so difficult to manage a position like this with stops because you got multiple options going on here at one time. You may have some puts in here going on, and you may have some calls going on. Whatever side of the market is giving me trouble, that's the side that I get out on. But I let overall P&L dictate it, not when an option. But you could go back and calculate where it would give you problems and put a stop there. But when that stop gets hit, it's probably going to be ran through in an options trade. You have a liquidity problem there. And when a market starts to break out, you'll see option prices move from $1 to $1.50, and it might be $2.50 on the next tick. So there's some risk with stops there too.
So what does your morning routine look like in preparing for the trading day? Do you ever meditate as well?
I like to. Sometimes I do go like a walk on a nature trail or something like that, and try to think about errors that I've made and errors that other people have made, not the potential of what I can make, but where I have made trading mistakes. And I need to really focus on identifying that, incorporating it. And I think it was Randy Howell said this too. He was talking about you need to mentally prepare yourself like an athlete does, because you have to condition yourself. And one of the things he was talking about was losses. A lot of people don't have the conditioning to take a loss. And I could see that in myself. And that is the initial stages of letting a loss get out of control. If you like he was talking about people that were making free throw shots. You sit down there, that may have been Mark Douglas that was talking about it. You're sitting there, you're making these free throw shots, and they don't, you condition yourself to make it. But when you get into the game, the pressure is on, and now that reflex that you built up, it may fail you. And I'm kind of circling around it, but you've got to build up a tolerance to take the loss at an early stage.
What you're saying there would seem to suggest that trading small lots and trade frequently so that we're conditioning our mind repetitively to take those losses.
Relative to your equity, your account equity, you have got to pull your trade size down. In the method that I'm using, you pull your trade size down so that you don't run into your 1% loss threshold too often. And I think you were talking about the Fund Seeder account. I think that my drawdown on there has been about, my max underwater curve was like 4%. I'm telling you, I overran my loss parameters when I had that 4% loss. And I had it over a couple day period. I overran my loss parameters. I think my trading size was right. I just did not get out fast enough. But I can remember that trade. Had I not gotten out when I did, that 4% loss would have probably been about a 20% loss.
Oh, wow. So do you trade while you're working full time? I mean,
yes, I
so
do.
how?
And I do. And I'll say this again, for options traders, anyone that's listening, and this is my opinion, probability and edge are two different things. Just because you put on a very high probability credit spread trade, and credit spreads of high probability trades, and I don't care what stripe they're in, iron condor, just selling cash secured puts, whatever, theta decay traders have a high probability of winning on every trade they engage in. But that does not necessarily mean that they have an overall expectation or going to have an overall realized gain, because the concept of edge and probability are two different things. And I struggled with that in the early years, but now with the loss control parameters in place, I'm getting a little bit better about not letting it eat my equity curve up.
What would you say is your edge? Loss control or something else?
Loss control is part of it. Probability is part of it. But trying to be in the trend and being able to identify it spread on, you just take and you turn it into a ratio spread, and you buy maybe the next strike price or strike price or two up, so that you wall off the risk, right? Like, I'm going to just use a hypothetical. Let's say I do a 10 lot and on the S&P 500 and the credit spread is 100 points wide. Well, that's $100,000 worth of risk. That's 1,000 times 100 is 100,000. Let's say the market starts to move against it. I'm all of a sudden now I'm showing a $1,500 loss. You could go in there and take and cut that $100,000 risk, cut it down to $5,000 risk by buying the next credit, the next strike price above the one that you're short. And I've worked around some things like that. And I've done that before and actually been able to pull it out, but it was by the skin of my teeth, because what will happen is that option that you're buying is almost cost as much as the option that you're short anyway, and you still got $5,000 worth of risk on. But then I could turn it into a straddle by getting half of it back on the put side. I've done things like that and I've made it work out. It's no such thing as I'm going to turn it into an ATM cash machine, right? Because the market just doesn't work that way.
Right, right. So wrapping up, where do you see yourself in the next 2 to 5 years?
My goal is to continue to I'm going to do this. It's not what I'm going to try to do. I'm going to control these losses, and I'm going to press this loss curve down. And if this account balance continues to grow as it has for the past 18 months, I want to get that loss parameter from 1%. I want to crush it down to maybe 0.75%. Because if you blow your account up, you don't trade anymore. And what blows your account up are out of control losses. What's going to mess you up on consistency is an out of control loss. You know, you're talking about fund seeder. You could take an account, put $100,000 in it, put it at a brokerage that pays an interest, the money market interest rate, and you'll get a good fund seeder score just on the interest.
Oh, really?
Yeah, because you'll have no drawdown, right? You'll get a decent score. You're not going to be very high. You're probably not going to be. You might be in the top 10. But I don't know what metric they use, an internal algorithm to determine how it goes. But drawdown is a critical number in there. Mm-hmm. And if you look at the top accounts in there, and there's a few of them in there I'm jealous of. One in particular. My hat's off to that trader too. If you're out there listening, you got it going on. But,
yeah. Well, congratulations on your evolution from a novice trader to a boom bust cycle trader to now getting consistency and getting a handle around your losses. How can our listeners reach you?
Well, they can send a text message to 252-532-0892, or you can send an email to BRYAN Holdford HOLDFORD @gmail.com. I'm pretty open to talk to about these things. And let's hope we don't fall off the loss wagon.
Yes. Well, you certainly have a lot of experience with that and have shared some valuable lessons with us today. Thanks for coming on the show.
All right. Thank you. Thank you for having me.
You betcha, Brian.
All right.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
One of the biggest jokes I see is people will be promoting their system or their model or their quant course or whatever it is, and they'll say, it takes the stress out of trading. You've got the signals, you don't have to worry about it. It makes it so easy on you. And guess what? Like, if you're losing, it still feels like you're losing. And if you're winning, it still feels like you get a bunch of losing trades in a row. It feels like you're never going to have another winner again, right?
Markets, speculation, and risk. This is the Chat with Traders podcast.
This is episode 269 on Chat with Traders. It's Tessa, your co-host. When I hear the words quant trading, it's like I have this instant, automatic resistance to it. I think because it just sounds intimidating, complex, abstract, and so much crazy work. I would think to myself, trading the regular way is challenging enough. Imagine what it would take to become a quant trader. Well, if it were easy, everyone would become one, right? Well, guess what? This episode is especially dedicated to the quant and quant-curious traders, and you may want to take some notes because Ian has done a great job extracting valuable insights from our guest today. Our guest is Rob Hanna. Rob is regarded as one of the prominent industry swings, overnight, and quantitative researchers. He has been known for his approach of evaluating market conditions and price action using uncorrelated systems. If I did my numbers right, Rob has been using quantitative analysis in his trading for at least 15 plus years of the 22 plus years of his trading career. We have included more information about Rob and his work in the episode show notes on the Chat with Traders website. After being laid off in 2001, Rob became a successful discretionary full-time trader until the shock of his first major losing year in 2004. This was the event that propelled Rob to find quantifiable statistical edges that would help smooth out his equity curves. Knowing the dangers of curve fitting in trying to find that perfect system, Rob zeroed in on simpler approaches that would combine seasonality, overbought, oversold, and Federal Reserve days. The result is a system that helps minimize anxiety and drawdowns while keeping him invested for the bulk of bullish moves. Ladies and gentlemen, we're so pleased to present Mr. Rob Hanna from Massachusetts.
Well, Rob, welcome to Chat with Traders.
Thank you so much. I've been looking forward to doing this. I've listened to your podcast for a long time, actually, and Tessa reached out to me. I was like, oh, wow, this would be really neat to do. So I'm excited to be able to talk to you with you.
Yeah, great. Great to have you on. Why don't you share with us a little bit about your background?
I went to Boston College. I grew up in New Jersey, and then I went to BC, and I studied economics through the business school. There was actually economics was offered both in the arts and science school and the business school. And I initially got admitted to arts and science, and then I decided to transfer to business primarily to avoid the language requirement. I didn't have to take a foreign language if I transferred to business. So that was my lazy way of switching to the business school. I've always been interested in the market. Even when I was in high school, I never traded when I was that young, but I remember watching movies and TV and seeing the market on and hearing about, I live in New Jersey, so I had several family friends. We were about 45 minutes to an hour from New York City. So they worked on Wall Street. They all did well for themselves, and it seemed like an exciting profession. So it was something I thought about. And then when I was in college, I had an internship on Wall Street at Garvin Guy Butler, where they traded Fed funds. It was like an open outcry pit, basically. And there was a giant marker board on the side, and they had a little elevated ramp that you would stand on, or I would stand on, and the brokers would all yell out their bids and offers, and I would have to update the marker board, erasing them and writing the new bids down. And that was my summer internship. And it's a little funny story about that is my first day there. I mean, I was pretty good in math. I was almost strong in math. So, right, I came in. The first question the brokers had for me was, well, how are you with math? And I said, fine. And they're like, how are you with your fractions? I'm like, yeah, I know my fractions. And they're like, yeah, sure you do. Go sit in the corner. You don't know your fractions when you got 40 brokers all screaming at you, and you got to know where to put what fraction between what fraction. So go sit in the corner and learn your fractions by 64ths. And I spent the first day sitting in the corner, learning my fractions, reviewing them, making sure I knew that 5 30-seconds versus 7 64ths and all that, which was higher when I was getting screamed at.
Wow. So that was back in the day. When was that? 90s?
That was 1991.
So they traded in fractions back then before they moved to, wow.
And they were all on phones. I mean, nothing was computerized. It was a bunch of brokers sitting at a desk talking on phones to the banks. Most of the trading happened, and it still does, like early morning or late afternoon. There wasn't, at lunchtime, most of the people were sitting around, and it was a lot of quiet. And every few minutes, someone would say to change a bid or whatever. But that was about it. What do they say about trading? And it still holds true. It's like whenever hours of boredom followed by panic. Right.
Mm-hmm.
It's like, and that's especially for day traders. It's not so much like that for me anymore. I don't do much in the way of day trading. Even so, it's, you got nothing going on and nothing going on and nothing going on. And then all of a sudden tons hits. Right. So life in general is like that. Right. They say things happen in threes and, everything's going good. And then all of a sudden everything's going bad. And that's trading is kind of a microcosm of life in that way, I think.
Yeah. So how about after your internship, after you graduated from school, where did you go to next?
So I wanted to stay in Boston, and that was in 92. I didn't want to go back to New York, New Jersey. So I did odd jobs for a while. And then I eventually went to Thomson Financial Software, part of Thomson Financial, which later became Refinitiv, which later now is part of London Stock Exchange. But I was there for 7 or 8 years. And what I did there is I sold their investment software. So it was portfolio accounting software that we would sell to large money management firms. And they would do all their back office stuff on it. And there was a trading front end for some places used it. But they'd run their performance reports, they'd do compliance, and they'd do accounting on our software. I had to get into these institutions and learn about their business and figure out how our software would fit in with them. And at that time, I became real interested in trading, and I started doing it myself. So I started with some simple, with a kind of a combination. I read the William O'Neill stuff, and I got into I would do IBD and look for breakouts and trade in that manner. And at the same time, I was also learning day and swing trading techniques. This was mid to late 90s. Larry Connor's site was called Trade Hard at the time. It later became Trading Markets. And that was my first kind of intro to some of the players there. I liked Larry and his work, and Dave Landry and his work, and Jeff Cooper. And so I would look for setups that I found that I learned from them. And then I would trade those setups each day and hold them, either for the day or for a few days.
So you were reading the Investors Business Daily publication, is that right?
Yeah.
And then were you using the Can Slim method?
Exactly.
Right. So what is that? Tell us for the listeners.
I can't remember right now what the acronym stands for. But it's basically the method that William O'Neill made famous, and he tracked in Investors Business Daily. And it looks to trade high quality stocks, high growth stocks that are breaking out to new highs. And he looks at certain patterns, like he uses a cup and handle technical pattern, or a high tight flag, or flat breakouts, or things like that, or flat base, excuse me, where you wait for a stock to hit a new high and break out of a basing formation, and then you hope that it's in an uptrend, or an uptrend is emerging. And so you look to ride that trend for a period of days or weeks or months. And so I traded that, and I traded that in conjunction with a lot of shorter term methods. So like Jeff Cooper in his book had these little setups. He would call them like funky little names like Gilligan's Island, or Turtle Soup, or, silly names like that, lizards. And I look for those kinds of setups as well. And one of the things I found is that some of the best swing trades actually occurred in the strongest trending stocks. So a lot of times I was kind of trading around my can slim positions, and it seemed great for a while. Of course, you did anything in the late 90s stock market. As long as you're going long, you were pretty much a genius. So my method worked very well for a while, as did most everybody's at that time.
So was there any distinction between the investor business daily approach compared to the shorter term trading approach? And was there one did you find in retrospect that was more effective than the other during that time period?
Well, the investor's business daily was more of a slower approach, right? So, and it had low probability win rate. Now, it didn't need a high win rate. So I could do very well being right on, let's call it 15%. I think I measured it out to somewhere between 12 and 15% of my trades actually went on to be sizable winners, but the rest were mostly scratches, right? So I'd buy the breakout, it wouldn't work, it would kind of come back to where it started or a little below there, where my stop point was, and I'd move my stop up pretty quick with them a lot of times, and so I'd scratch the trade, and I'd end up scratching, and then once in a while you'd hit a winner, and it only took a few winners a year, if you're making a 50 or 100% in a position to really matter. The day and swing trading methods I utilized had much higher win rates, but of course, we were making a few points in a stock rather than 50% or something like that. You're only holding on to it for a few hours rather than a few months.
So you were doing this while you were working a full-time job?
Yes.
I see. Yes. Did you later transition to full-time trading?
Yes. So around the end of 2000, I left Thompson Investment Software, and I went to BMC Software, and I sold their software for a little while. I wasn't very happy there. I knew I wanted to be a trader. And so I had a friend who worked with hedge funds, setting them up. And he basically gave me the documentation I would need if I wanted to set up my own fund. What I did is I set up a fund, and I established it in August of 2001. And it was my money and a little bit of my parents' money. It wasn't a lot of money, but it was set up as an LLC, or set up as an LP, which was managed by an LLC. And it was just so that I could really be able to show up. What happened. And there was big layoffs at BMC like a month later. And I was part of those layoffs. And I said, you know what, this might be my opportunity to become a full-time trader. And so that's kind of where I started. It was getting laid off that got me my full-time trader position.
Right. So did you just work with that?
Yes. So I did that for a bull market year, but I did well in all of them. I was good at staying out of the market during much of the bear market and taking shots with some shorts and making money there. My swing trading methodologies were doing pretty good. So I was scratching out decent gains, nothing huge, but I was making money when everybody else was losing it. So that was pretty good. And then in 2004, that was my first real tough year. Like I said, I was trading a lot of can slim type stuff. And what happened in that year, it was a very rotational market. So, energy stocks would break out, and then a few days later, they'd collapse back into their base, and you'd see tech stocks break out, and then they'd fall back into their base. And then consumer discretionary would break out. And so I was taking a bunch of stuff and getting churned and completely chopped up. And that was my first down year. I wasn't down a whole lot, but it was frustrating because now I'm a full-time trader, right? So if you don't make money for a year, that's tough.
Mm-hmm.
And so that led me to kind of rethink a lot of what I had learned and relook at methods and look at the weaknesses in my approach. And I was good at riding the trend when I was able to capture it. What I was not good at was picking tops and bottoms, right? So I was always over-invested at the top, right? Because we were riding the uptrend. And I was always under-invested at the bottom because I was partially short, and the bottoms were even more severe. So I began doing the first of my quantitative research, and I studied bottoms and how they formed. And I did it with, I looked at as long a charts as I could find for the S&P 500, for the Dow, for the NASDAQ, and then any of the, sectors. So I looked at sectors going back a long time as well. And I started researching, and that kind of led me to starting to develop a quantitative method, right? So from that research, I developed some models, some that I still make trades in today, and they do a good job of picking bottoms. Anyone that's followed my work has probably seen me talk about my capitulative breadth index and what I call my catapult system. That was something that came out of this initial research maybe it was a couple of years after that. It was around 2005 or so 2006 that I was really starting to get into, all right, how do we take advantage of these big reversals off bottoms? Because my thought was, if I had a method to take advantage of that reversal, I already had a method to do the trend and so forth. So that's I was trying to fill the holes at that point in time.
I see. So up until that point, you were a discretionary trader. Is that correct?
Yeah.
Uh-huh. Yeah. And so you had quite a few years of success under your belt. Did you feel that the 2004 experience was kind of unfixable, or did you get into quantitative research as a way to supplement your discretionary trading?
Initially, I did it as a way to supplement it. Yeah, it wasn't that I thought my entire approach was broken, but I wanted to be able to, fill in the gaps in my trading. And so that's what I was initially looking to do.
So how were the first few years of being a quant trader?
The methods I used to trade individual stocks and like that catapult system did very well from the start. But then I had other methods that didn't do nearly as well. So it was a little bit of trial and error back then. And I was still learning how to design a system without over optimizing, right? So you don't want to say, hey, this is an approach that would have worked on this chart in the past, and now how do I get rid of the bad trades? Like, that's the worst way to try and build a system. And that was kind of my thought early on was, well, how do I get rid of these bad trades? Really, you want the bad trades to be in there so you can see what the potential downside is of using a system. So once I figured out research was more for learning about market tendencies than it is trying to find the Holy Grail, that helped me an awful lot.
Mm-hmm. Were you a programmer prior to becoming a quant?
No. So I took Fortran in high school. I don't know if that's still a language, but I learned how to program in TradeStation. I basically, read what was the TradeStation easy language book at the time and started messing around in TradeStation. And it kind of came back to me a little bit at that point, like how to think through writing a program. And I later learned that easy language was based on Fortran. So it was easy for me to kind of start to learn how to do it. And so that was something that, I'm still a hack at programming, but now I'm a hack in numerous languages, I guess you'd say.
I've read in some of your publications, you say that quant analysis is the next generation of technical analysis. Explain for that a little bit.
Well, so technical analysis is basically looking at chart patterns, right? So whether you're looking at support and resistance, or whether you're looking at what volume might mean on certain bars, or what it means when you're oversold or overbought, you need to be able to read a chart, or at least describe a chart. So if you look at a chart, you need to understand the chart, right? So, hey, we opened at the low, we closed at the high today, and we did it on big volume, and we did it, and we closed at the highest price of the last 2 weeks, but we're still in a long-term downtrend. Whatever. You need to be able to describe what's happening. And a quant approach basically allows you to test all those patterns that candlesticks and other technical analysis type of approaches look at. So if just the simple things that I look at. So, or a few days ago, I was looking at what happens if we have 3 down days and we close at a 10-day low and we're above the 200-day moving average. That's all something that you look at a chart and you see on a chart. And then I use a computer to describe that and say, all right, what's happened over the next 1, 2, 3, 4, 5 days, whatever, every time we've had that setup in the past. So it's a matter of looking at the chart, describing the setup to yourself, and then seeing if it means anything moving forward. And sometimes it does, and sometimes it doesn't.
I see. So before one gets into quantitative analysis, sounds like you highly recommend getting very well versed in technical analysis first, because that is the bedrock of which quant analysis is based on.
Yeah, and you don't have to know necessarily, what each pattern supposedly means, because you're going to go out and try and figure that out yourself, right? But you do have to be able to identify moves in the market. It's nice to be able to test, all the candlesticks, for instance. Typically pretty easy to test if you put reasonable parameters around them. A lot of things that are in technical analysis are a little vague, and so I try and make things less vague. I did it. So, for instance, the whole idea behind Investors Business Daily and the CAN-SLIM methodology is you're buying strong stocks that are breaking out, and you're looking to capture an uptrend. And most of what he teaches, I think, is really good. But the one piece where he doesn't, I believe, teach it well is the M, which stands for market, right? So one of the things that he looks for is, after there's been a decline in the market, he looks for a follow-through day, right? So that's the market reverses, and then a few days later, there's at least a 1% up day on very strong volume. And that's supposed to give the all clear to start buying breakouts again, according to the book and the newspaper. So I spent a long time studying follow-through days and quantifying them. And it sounds pretty straightforward, but it's not. Like, how much of a decline do you need before you're looking for a follow-through day? How strong does the follow-through day have to be? Can it be in any market? What is your definition of success on a follow-through day? Like, does the market need to reach a new high? Does it need to go up at least as much as it's already gone up? How long from the low until the supposed follow-through day is valid? I think they said somewhere between 4 and 10 days is best. So I tested that. So these are all little nuances that years ago, and you can still find it on the blog, back in like 2008, 2009, 2010, I was testing the concepts of follow-through days. Overall, I found them to not be terribly helpful in market analysis. But all the other ideas many of the other ideas I did find useful for, that William O'Neill puts out there. So you certainly can make money buying breakouts and riding trends.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital, or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So was your objective at the time to create a system that would give you the signals, for example, go long this, go short that, so that you wouldn't have to spend so many hours on the screen every day looking at every tick like is so common with many day traders?
Yeah, but I also wanted to have a way to set my market bias. So that was really what I was studying at night. So when I would go, I might be long or short a position. And if there was a real strong move against me, let's say, that felt horrible going into the night, right? So what I would do is I would take a look at what the market's done, where it's at, and is there a reason for me to still be in this position? Did the big move against me signal a failed setup? Should I be getting out right now? Or is the upside edge apparently still there? Or maybe it's even stronger at this point. So that's the kind of thing that I was trying to understand. And that's one of the things I found over the years, that quantitative analysis for me has made it easier from a psychological standpoint to trade. Because when I would be in a position, no matter how I felt about it, I'd do my research that night, and then I could say, all right, today was a bad day, but it looks like we're likely to turn in the next few days. So I got to hold on to this position still. Or the opposite, where, today was a great day and it's unlikely to continue much further than this, time to get out.
So was the quantitative analysis that you were doing acting as like your advisor at the end of the day to help say, hey, look at this data, the probabilities that it's going to continue the up move, or you should get out, what have you. And you were making the trades manually. Is that correct?
Yeah. Yeah. So I'd be, back then I'd have manual positions. I mean, I still take trades manually, but not discretionary, right? Most of my trading is based off of systems these days, or models that I've built. So it would let me establish my market bias, not just for those positions, but what's important is for, whatever new positions I'm looking to consider, right? So, and this is something I've done for 15 years or so, and still do to this day, where, I do my market analysis every night, and I want to have a bias going into the next day. And whether that's basically, I keep it simple. Am I short-term bearish, bullish, or neutral? And if I'm short-term bullish, I'm only looking for long positions. If I'm short-term bearish, I'm only looking for short positions. And if I'm neutral, I'll look for either, but they need to have a real high probability behind them.
Did the quant information that you would get at the end of each day then act as kind of like you were almost like a psychological guide to help you determine whether you're going to get in or out of that position, so that did you have to deal less with the regular psychological aspects of trading mentality, because you had this quantitative advisor, so to speak?
Exactly.
I see. So you did you find that, did that help you get around the psychological challenges of regular trading?
Yeah, it helped me greatly. I mean, you kind of start off, a lot of people do with maybe what you call a gambler's mentality, right? And you ride the ups and downs like you're at a craps table, right? Really, you don't want to be a gambler. You want to be the casino. So by constantly studying the odds, I've been able to turn my trading from being, hey, I was a pretty good gambler, but now I've always got the odds in my favor, not always massively in my favor, but I know what they are, and everything's measured before I go into a trade.
Are there any unique type of psychological or mindset issues that are unique to quants that you still have to deal with?
Yes. I mean, it doesn't, one of the biggest jokes I see is people will be promoting their system or their model or their quant course or whatever it is. And they'll say, it takes the takes the stress out of trading. You've got the signals. You don't have to worry about it. It makes it so easy on you. And guess what? Like, if you're losing, it still feels like you're losing. And if you're winning, it still feels like you get a bunch of losing trades in a row. It feels like you're never going to have another winner again, right? And streaks still feel as bad when they're going against you, and they still feel as good when they're going your way. But you've got, I think, a little more assurance of yourself. Like, you've got a little bit more of a reality check that all right, it's not going to always be this bad. It's not going to always be this good. And you can see that in the data.
I see. Were you ever tempted to convert your quantitative approach to also an algo approach so that you wouldn't have to deal with any of that? Just let the algo trade for you.
Well, yeah. I mean, some of the models that I trade are basically what you'd call algo models, right? So, in fact, most everything is these days. So I don't necessarily let it drive itself from the standpoint of, like, none of them are day trading models. So what I do is I'll run the model at night and I'll see what's triggering, and then I double check before a trade is placed, because I want to make sure that it's not kicking off something odd. So, for instance, if I get a signal to go long some S&P 500 stock, and I just let the computer go and do it, and I don't look at the chart, I may not realize that, hey, that stock just got, that company just got bought out. It's really, it's just going sideways for the next month or so till the merger is complete, right? So I always want to make sure the signal is correct, and even with and sometimes the software kicks out a bad signal. You get a bad tick or something like that. So I don't just let trades flow through. I always check and then enter my orders manually.
I see. Do you think that some people get into quant trading or even algo trading, say, for the wrong reasons, like, say, not wanting to deal with the trading mindset and the psychology and the cultivated intuitions and screen time that's often necessary, and surrender it to some kind of an automated system or a system that's kind of outside of themselves? Do you ever see any issues with that?
Yeah. If you're not, well, you can't push it off to the computer or even to someone else and never worry about it again, right? If it's not in your personality. And it depends on how big of, a portion of your portfolio you're pushing off. It's easy to say, hey, let's take 10% of my portfolio and run with it this certain way. But if you're a beginning trader and you can't divide your portfolio into 10 parts, you just need a model to start to run with, then you really should be involved in learning about it if you have an interest in it. Regardless of what the model is or whether you're trading it or someone else is trading it, you're still going to live the ups and downs. You're still going to get excited when it does well, and you're still going to get disappointed when it doesn't, right? So if you go into algo trading thinking, hey, I'm just going to, push the buttons or flip the switch and it's going to make a bunch of money for me, you're going to get disappointed. And if you don't know what's behind the system, if you're not certain what the system is based on, if it's not true edges that it's looking to take advantage of, then that'll bring in even more doubts. So even if you have a system that's great, it's going to go through losing periods, and you're going to get scared out of it potentially if you're not confident it's great.
So what are the differences and similarities between quantitative and algorithmic trading? Are they essentially the same, except for the quantitative it's still a manual approach that you eventually hit the buy and sell, and the algorithmic trading is taking that same data and automatically trading for you?
I've never made a distinction myself.
Oh, okay.
But yeah, I mean, the way we've been talking about it, for me, a quantitative approach is just understanding the odds, right? However you want to define that. But I guess an algorithmic would be completely computerized, right? And I think without that kind of, without any intervention for pressing the button, right? So a mechanical system that can run itself rather than you having to run it. I've had algo systems in the past that I set up, for instance, in TradeStation that, you turn on in the morning and turn off when the market closed. And to me, they're no less emotional and they're no less worrisome, right? If you get an internet outage or the computer crashes or, whatever happens, there's still a million things to worry about with algo as opposed to doing it manually.
I'd like to dive into a little bit of the perceived complexity and difficulty of being a quant. Have you estimated how much time you needed to spend over the years, programming, researching, backtesting, and how often potential strategies are thrown out because they're overused by others in the past?
Let me break that down. Are you asking how much time I spend?
Yeah, over the years, the time that you invested in doing all this research to come up with various systems, and how long were you able to use these systems, and that whole process?
So I haven't thrown out a whole lot of systems over the years that I mean, that's not true. I've thrown out a good number, but I rarely tweak systems. I take a real broad look at the edges I'm trying to identify. I look at general ways to take advantage of those edges. I make sure that the edge is robust, and I don't want a system to work with certain parameters and not others. So as long as the edge persists, I've been able to continue to trade models for years. Most of the models I have now are several years old. I mentioned like the catapult system I designed in, I don't know, it was 2005 or so. I still trade it as I wrote it many years ago. The way I trade, I've had a few SPY systems over the years, but the ones I'm trading now I've had for 4 or 5 years at least. There's I did a market timing course at Quantifiable Edges in 2014, and it's a simple course, like you go through it in like an hour, and it's more intermediate term, but it takes a look at 4 different indicators, and 2 of them are price based and 2 are seasonality based, and it looks at is there an edge? Do these provide an edge, and how could we combine them? And I did that in 2014, and then I updated the course this summer, and I showed how the models that I did then have continued to perform over the last 9 years. And as far as I was concerned, nothing needed changing. I did add one more indicator that's based on Fed liquidity, and so I created one more system out of that in the new version of the course. But for the most part, if you find an edge that is able to persist, it can persist for a very long time. Now, not everything persists forever, so you got to be able to identify that. But you shouldn't be making a new system every month or every year.
So I imagine the temptation would be is to try and find the holy grail of systems, to say, oh, what if I add in this indicator and subtract that one, and let me backtest it and backtest it over different periods of time. So it sounds like you've hit on a system that is performing well enough, and you have not been too tempted to try to tweak it and retweak it until you, quote, get that best system.
Right. Find something that works pretty good and that you can live with the ups and downs, and then combine that with other systems that do completely different things. So, I have a few models that I call my swing models that I trade for myself and for clients. I'm an investment advisor in addition to doing quantifiable edges, and so I have what I call my swing 100, my swing 400, and my ETF swing, and they're similar to each other in concept, but the swing 100 and swing 400 both trade S&P 500 stocks, right? So those do that, and then I have another system that trades SPY, and that is based off of, the initial swing systems are based off of concepts I did years ago on, price stretches, and we're looking for rebounds, reversion to the mean type stuff. And then my Spy Hunter system is based off of VWAP. It's a different indicator. And then I have one called duration rotation that trades treasuries. And I have VIX systems. And so, if you have systems that are uncorrelated to each other, and then I got the models from the market timing course I mentioned, right? So that's more of a trend following. So if you have systems that are uncorrelated to each other, that's where you get real value. It's not the perfect system that's going to make you a bunch of money, but if you have several systems that all can be making money at different times or come in, then you've got a real edge. And that'll allow you to use leverage as well and still maintain a fairly smooth profit curve with lower drawdowns than you would have with any individual system. So
Right.
individual systems might have 25% drawdowns, but you combine them all and you put a little leverage in them, and the max drawdown might be 15 to 20%.
Yeah, I noticed that you have looks like 10 different systems. Is that accurate? 10 main portfolios.
So the numbered systems are on the Quantifiable Edges site, and those really are just they're setups I created long ago, and they're very simple that people can. They're not like a complete portfolio system, but they're simple setups. So if the way I've traded them in the past is I will publish any triggers that are happening for the numbered systems on a nightly basis. And then people can go and see what the stats are on that system, what the stats are for that particular security that's been traded. So maybe, Microsoft's done especially well with it over the years, and Microsoft's triggering today. Well, you can see that. But I generally suggest, you don't want to be looking at long triggers when the market bias is short. You don't want to be looking at short triggers when the market bias is long. Those are really just kind of trade idea setups. Those aren't complete systems with risk management with position sizing built in.
I see. How often do you get long or short or exit signals from your system and then choose not to take the trade?
If it is one of the models that I trade for myself and for clients, never. Like I don't override any of them.
Okay, so you don't have there's no problem with second guessing.
No.
Yeah.
No.
I see. What about curve fitting? We often hear about curve fitting when doing back testing. What is this, and how can we avoid it?
Curve fitting is basically it's what some people also refer to as over optimizing. You're trying to find the perfect parameters that gave the best profit curve in the past, right? So let's say you design a system that gives a 20% return over the last 10 years, but it's had a 50% drawdown at one point. Someone that's curve fitting might look at that and say, all right, this system looks great. How do I get rid of the drawdown? And right, you want to, because you're trying to sell the curve to somebody else, or you're trying to convince yourself that, if I just knew how not to let that bad thing happen, then I'd be fine. And it seems reasonable when you're first starting a program, like, all right, how do I get rid of the bad things that happened? But you never know what the next bad thing that's going to happen is. So someone that's curve fitting will say, all right, well, what happened in this instance that may not have happened at other times? And then they'll make a rule to avoid taking any trades when this particular thing happens. So maybe it was right before the flash crash, or right before the crash of '87, or right before COVID, or whatever it was, and they note something that happened in a few bars or on a bar, and they say, if I just avoid any time the setup has this trigger, I'll be fine. And those are one-off black swan type events, and black swan events happen a lot more often than you would think, but they happen in different ways every time. So you fit the curve to the past. It doesn't help you anticipate what the next real market event is going to be. Is it going to be another COVID Is it going to be a war? Is it going to be a financial crisis? Is it going to be a computer virus that's taking over? Who knows? There's going to be some kind of a liquidity crisis emerge somewhere, somehow, and you don't know how the next one's going to happen. So if you curve fit to the past, you might know how to avoid the COVID crash, but that's not going to teach you how to avoid the next crash.
So when backtesting, is there such a thing as an ideal time period to backtest? Are there significant differences, say, between using 5, 10, or 20-year or more periods? And you mentioned in your documents that you like to have an ensemble of data. What is this, and how do you collect these various different points of data to come up with your strategy?
Okay, so one of the models that I post on quantifiable edges, and that I talk about ensembles. So I'm thinking maybe you're referring to like the seasonality stuff that I have up there.
Yes.
Okay. So that used an ensemble approach, and that's just one way that you can approach testing. Effectively, what it does is it takes multiple systems and then combines them into one system, or multiple models and combines them into one model. So, for instance, the seasonality model might have two models, one that looks at day of month and another that looks at, say, day of year or week of year, right? So you can break seasonality down any way you want, month of year, week of month. So that's basically what the seasonality models do, is they say, all right, I have one model that just looks at day of month. I have a second model that looks at week of year, and I'm going to run those models independently and take whatever stats come out of those models and then average those stats together to give me my answer. So the stats would say, today's the third day of the month. The market's been up 60% of the time on the third day of the month, and the average day has made 0.1% or whatever. We're also in the third week of the year. So the week of year one might say, all right, we're typically down in the third week of the year, and it's by this much and this percent of the time. And so you take those stats and you average them together, and they might say, oh, it's neutral. Whereas if they were both saying, hey, we got an edge here, then you might have a bullish trigger for an ensemble type model. It's something that they do with like forecasting hurricanes, right? So they'll have multiple models to forecast a hurricane, and then they take the average one, and that's where you get the track that they have, real wide, and then eventually it narrows and narrows as the models come together. The event comes closer.
Yeah. So for your system, I understand you also look at price action and internals.
Yes. So I'll look at really anything that I think can generate an edge. So price action is just looking at movement on charts, right? So, and you can measure that with indicators like RSI or Bollinger Bands, or just saying, hey, we were up 3 days, down 3 days, or, it's the biggest day up in the last 2 weeks, or we're hitting a high or hitting a low, anything like that. I kind of throw into the price action bucket, right? You can learn a lot from price action. That's number one when you're looking at designing stock trading systems or systems to trade the indices. And then, I'll look at whatever else I can find. So volume or sentiment measures or seasonality measures or breadth. All of these can clue you in. And sometimes they'll be saying different things. We might have real strong seasonality, but lousy price action. So they kind of balance each other out a bit, and not a great time to trade. But if you've got breadth and seasonality and volume all telling you at the same time that we're likely to get a move higher, that's where you really want to press the gas and jump into a bunch of trades.
You, some number of years ago, you put out a publication on Amazon, Quantifiable Edges Guide to Fed Days. And given that the Fed day is tomorrow, What are your thoughts on since the Fed days have statistically shown a positive expectancy? What is your take on going long now, given that the market has been down a number of days?
Well, in general, when you're right, Fed days have been a positive event. So, come up with any conspiracy theory you want there, right? The chairman want to look good. So the Fed days are up more often than not. And so Fed days have been a generally bullish day. What my research has found is that when you have the market doing poorly heading into a Fed day, it's been an even stronger bullish edge. And when you have the market ramping up and going higher into a Fed day, that's greatly eliminated the bullish edge. It hasn't become bearish, but it's been kind of neutral. And I looked at it a number of ways. So it might be, hey, are we up a bunch today going into tomorrow's Fed day? That means we might have some front running. Or are we down a bunch today going into tomorrow's Fed day? That means everybody's afraid of what the Fed's going to say. And so when the Fed day occurs, if you're not thinking conspiracy theory, then it could just be, hey, whatever we were afraid of, well, here's reality now, and it's not as bad as we feared. And so now the market can look past it and can bounce a little bit. That's one of the reasons I think when you get a sell-off heading into a Fed day, you often get a bounce on the Fed day. Now, there's another reason it might happen is, and I don't think we see this as much anymore, but in the past, if we're in a bad market, the Fed might be trying to calm the markets too, right? So they'll say something that will allow the market to rally sometimes. And that's, if we're in a real difficult environment. Or they might be trying to cool the economy at some point, and that they'll tamp down what was the phrase Greenspan used?
Irrational
exuberance. Yeah. So they're trying to get rid of irrational exuberance in the market, and so when we're overbought headed into a Fed day, it might come down some. So whether it's whether you're looking out over a 10-day period or a 1-day period, a strong move up into a Fed day generally eliminates your edge or reduces it. A strong move down into a Fed day, there's a good chance you're going to get a bounce the next day. Now, a couple other interesting things about Fed days I'll share. One is that most of that upside edge actually comes before the announcement. So if you measure from the close of the day before the Fed day until 2:00 the next day, that's where the edge is. Everything after that 2:00 announcement is pretty much noise when you look at it over the long run. So if you're looking to get in because we're selling off heading to a Fed day, you don't actually need to hold through the announcement. You can get most of the benefit by getting out before the announcement.
I see. Looking at a little bit longer term, I noticed that since the market low of last October, the market's up around 25%. But at the same time, the T-bill rates have increased from 3.5% to 5.3%. Is the old mantra, don't fight the Fed, now dead?
I don't believe so. The Fed has been raising rates, and they've had quantitative tightening going on since March of last year. So we're still kind of around where we were then. I haven't found a huge edge in rates, like going up and down. I have found a bigger edge in looking at liquidity from the standpoint of quantitative easing or quantitative tightening. And that can be measured back to 2003 is when they have the data on the Fed website. Looking back over the last 20 years, back to 2003, basically all the gains in the market have come when there's been quantitative easing happening. When there's been quantitative tightening, then we've actually had a slight loss in market value over time. Not very big. We're better off having the Fed on our side. If they're providing liquidity, that finds its way to the market. If they're taking liquidity out of the system, that's going to eventually hurt the market. I have found in my experience that the Fed goes too far with everything also. So
Mhm.
If you think back to 2 years ago, we had the Fed saying we need to get inflation up over 2%, and we need to hold it there for a little while. Congratulations. 9 months later, they had it at 9.5%. So,
Right.
right. So they completely overshot to that side. And I think they're, if not already overshooting, going to overshoot in the other direction as well.
Well, I mean, of overshooting, isn't the market's current action of just kind of going sideways, mostly slightly down, isn't that a good indication that their quantitative tightening is actually just right, kind of the Goldilocks temperature, and that they're not overdoing it?
Yeah. So it's good so far. They haven't overdone it yet, but my inclination is, like I said, they tend to overdo everything. So are they going to stop before something breaks? I'm not optimistic of that. What's going to get them to lower rates? People think that we're going to have lower rates starting, 2024. Well, if that's true, what's going to make them start lowering rates in 2024? Slowing economy? If it's slowing a little bit, I don't know. Probably not. I mean, they're insisting they got to have inflation down below 2%. So I don't see that we're going to get it below 2% and have the economy slowing just a little bit, and they'll dial it back a little bit and things will be hunky-dory. I think they'll probably overdo it. Something's going to break, and that's going to force them to lower rates and try and get the economy, going again. So that's my fear, and that's kind of the experience I've seen over the years with, when they're trying to get the economy hot, they get it too hot. When they try and cool it off, they cool it off too much.
Mm-hmm. Well, hopefully this time they learn from all their previous mistakes and they just get it just right.
Hopefully. I think the problem is not that necessarily the Fed is dumb, but they got blunt tools. There's only so much they can do, right? And so I don't blame them for overdoing all the time, but I do think it's an issue, and I wouldn't be surprised if we saw a recession not too far down the road. There's now what could pull us out of that? I don't know. AI. Right, that's where all the excitement's at, and maybe we get more excitement there, and it becomes the next, internet bubble, and that'll eventually break. But there's going to be events down the road, and as traders, we got to prepare for them.
Yeah, I notice in your weekly newsletter you have what's called an aggregator line, which goes above into the positive and down into the negative. What are the components that go into the aggregator line to help aid you in determining whether you're in a kind of a bullish or bearish environment?
So that's just the aggregator takes whatever studies I currently have that are active. So when I'm looking to set my market bias, I start by just looking at what the market did today, right? So if I look at the market as we're talking, the S&P gapped down. It went lower for much of the day. It's been bouncing. Now it's about where it opened, but still lower on the day. So I might look and say, all right, based on where yesterday was an up day, so we have an unfilled gap down from an up day, and it's a day before a Fed day, but we're closing at the top end of the range. I'm just making stuff up. Maybe that's something I find interesting, and maybe I say, oh, there's big volume in there. What's happened in the past? So I'll go and examine that. Now, that might be a new study that I look at, and I try and look at some new things each day if I notice something in the market that's unusual. But I've got about 1,300 studies that I've saved that I have programmed that will trigger. So if they happen again. And so then what I do is I go back and if something triggers that I've studied in the past, my program will pop up and it'll say, oh, this is happening. And last time it happened was 2018 and you wrote about it on this day. And then I'll go back and read it and then rerun the study and see, okay, it looked like based on what I said before, it was bullish. Does it still appear to be a bullish edge, whatever the pattern is that I looked at? And if so, I'll include that as a study that I want to, maybe it says over the next 3 days we're up, 1% on average. So I'll take that information into account and say, all right, so we should be up about 1% over the next 3 days based on this small look at the market. All right, now that's one look at the market, whatever that study is. I might have 5 different looks at the market. One might be, hey, we're down 3 days and it's price action or whatever. And when there might be another one that says, hey, the market was down a bunch yesterday, or up a bit yesterday, but breadth was terrible, or we were down a bunch, but breadth was great. So each study might last for 4 or 5 days. So I might have 5 or 10 studies that are active, and I might have 7 of them that are bullish and 3 that are bearish or whatever. The aggregator just aggregates my studies. So it says, all right, on average, what's all the evidence saying? And if the evidence is saying, looks like we got a bullish probability over the next few days, then that's what the aggregator line says. The aggregator says, all right, looks like we're probably going to be up over the next few days. And it's just taking those studies into account.
Mm-hmm.
Now, the other thing I look at is, are we overbought or oversold versus where I thought we would be based on the studies for the last few days? So if we're oversold and we've got a bullish outlook, that I look as a favorable environment to trade in. Favorable outlook, bullish outlook, but we're overbought already, then potential reward's not as great there.
I see. And overbought and oversold are measured by what, RSI?
No, I just so on that same chart I have what I call a differential line. So that measures, if the studies had said we're supposed to be up on average 1% a day over the last 3 days, and over the last 3 days we were up 0.5%. Rather than 1%, we're oversold, right? We're relatively oversold based on what the studies are saying. If it thinks we were supposed to be up and we're down, then we're really oversold. But if it says we're supposed to be up 1% and we're up 2%, now we're overbought.
Mm-hmm. I see. One of the systems that you use is called the catapult system, which I think you call it the capitulative breadth indicator. Is that accurate?
Yeah. Yep.
And is that what is that? Is that looking at stocks that have had a sell-off and you're looking for some kind of mean reversion?
Exactly. So all the capitulative breadth index, it's called CBI for short. That's from I mentioned the catapult system earlier that I designed that like 2014 or I'm sorry, 2004, 2005. And that looks for stocks that are undergoing extreme selling and have been in a strong trend already. So it's probably the end of the sell-off. It's like the blow-off. I look for that in S&P 100 stocks. So just the biggest of stocks. And the CBI measures the number of triggers that are active at any one time. So when we have many stocks that are having what looks like capitulative selling occurring, that means there's a real good chance that the market as a whole is undergoing capitulative selling and is about to bounce. So the CBI is something that I look at that really comes into play probably 2 or 3 times a year, where we get, some strong sell-off that the CBI spikes and all of a sudden it's, hey, we're probably going to get a bounce here in the next 2 or 3 days.
Mm-hmm. How do these CBI readings connect to the VIX levels? And do you ever use VIX in combination?
So they don't. CBI is really just looking at individual signals in S&P 100 stocks. The VIX is something I trade a lot, but it's completely separate research and separate signals. The VIX is something I would suggest people learn more about. There's a lot of misinformation on the VIX, and there's really large edges around trading VIX futures, VIX options, and VIX ETFs and ETNs, and understanding some of those edges. It's probably my favorite group of securities to trade. Because I feel the edges are so large.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So to wrap up, what do you struggle with most as a trader?
As a trader, well, what I struggle with most is my time. But as a trader, I think I've evolved to the point where, buy and sell decisions are generally pretty easy. I've got a lot of my models built out. There's always more to learn about the market, and I'm always curious to find new things to trade that are uncorrelated with what I'm already doing. So that's where most of my time goes these days, related to research. It's not taking my models that I already have and making them better. It's finding other models that use completely different edges that are uncorrelated. And so how do we do that is kind of the next big, is always the next big challenge for me these last few years. So for instance, a lot of my VIX signals that I use and trade are based off of, the tendency for VIX ETFs and ETNs. So the ones I trade there, there's a negative bias for those over time. The VXX and UVIX will fade, and so there's a real short side bias to them, and I trade them short, going in and out a lot of the time. Well, is there a way to use VIX securities to trade with a long bias and or long VIX, I guess? So really use it for protection against a portfolio. And that's something I've developed over the last 2 years. The next time it helped me a lot last year, right? We saw several big sell-offs during the year, and mini VIX spikes up into the mid 30s, high 30s, in February when there was the Russian invasion of Ukraine, again in June, again in September last year. And so having a model that was able to take advantage of VIX spikes was something that helped me greatly in my trading, because I had some other things that were struggling. So just finding complementary systems, complementary models, complementary edges is my biggest challenge these days.
What would you suggest to those traders who are interested in taking the next steps in diving into quant trading? Because some may listen to this and say, "Wow, it feels like almost like double work and perhaps higher barriers to entry." How much programming do they need to learn, or if any? I mean, what kind of off-the-shelf software programs are available for new traders to get involved in this? At the end, I imagine you feel it's worth it now.
Yeah, if you're going to trade, you have to learn a program, because you got to test your ideas. You're going to have ideas, and you want to be able to see how those ideas have worked in the past. And it doesn't have to be, you don't need to be some advanced C+ programmer or program in Python or anything like that. There's plenty of software out there now where you can, they'll claim you don't need any programming, but I really think for robust stuff, it's worth learning how to program a little bit. Even if it's in Excel, you got to be able to test your ideas.
Mm-hmm.
So TradeStation I've used for many years. It's good for trading, for testing out ideas on one security at a time. For testing out portfolios, it's not as strong. I learned AmiBroker maybe 6 years ago, and that's very powerful. It can be a bit of a steep learning curve, and you may need help in programming some things, and there are programmers available on the AmiBroker in the AmiBroker forums. Software that I've started using in the last year is called RealTest. I like that a lot. I think it's very simple as far as figuring out how to test things, and they've got some great example programs in there. So I would probably start with RealTest if it was someone, but whatever it is, you got to learn to test your ideas. Like you want to know that whatever edge you believe you have, you really have. Don't take anything at face value, even if you know it's true. I used to say, I never believe anything I read about the market, even if I wrote it.
Well, then I guess In that case, it's best for you not to read the news on the financial markets, right?
Well, yeah, I mean, the news keeps you somewhat informed, but it doesn't really help a whole lot in trading. But I mean, even studies I've written in the past, I don't believe that they're still true. I always go back and retest them.
Mm-hmm.
Right. So, and if I have a model that's not doing what it's supposed to do for an extended period of time, then it's time to consider getting out of not trading it anymore. Right. But you won't know that unless you go back and test. I'm actually working with someone now who wrote a model many years ago, and he asked me to take a look at it. He said, well, I'll be surprised if this and this and this happen. And I said, well, I'll be surprised if you're not surprised when we look at some results. The first thing he did when we came back and said, well, you were right. I was surprised. I didn't realize that this and this was going on. Even if you feel like you know your edge, it's good to confirm it. One thing I did when I first started trading is, I didn't have the ability to test everything, but I would write down the reason for each trade, and I would track it and I used the portfolio accounting software I used to sell, but you could do it in Excel. It's very simple. You just, this was my entry, this is my exit, this is what I made or lost on the trade, and this was the reason I took the trade, right? And the reason was, the whatever the setup was called. So like it was a Jeff Cooper setup. It could be a lizard or Gilligan's Island or whatever I was talking about. And if I didn't have a reason other than, I thought it was going up or something, I would write hunch. And I would go back and look at my results, and I could see, hey, these setups actually work better. And what I learned after not too long a time is the ones that I wrote hunch down next to, those were the worst.
Well, then that's a good point for journaling, right?
Yes. But you got to journal in a way that you can actually go back and summarize your results, I would say, at least in a spreadsheet, right? So add them all up. Journaling is not just about writing about your feelings, right? You want to know the results and be able to break it down in a quantitative way so that you can understand where you're falling short and what you need to do, what systems are working for you, what systems aren't. And they may come in and out of favor too. So if you know a system's been great over the last, 15 years, don't throw it out because it's had a rough 2 months.
Right. Well, how have the last few years of this choppy market been for you?
So it's they've been interesting, right? So 2021 was easy. That was a great year for me. And then 2022, it was split. So I had some models that really struggled. I had some models that did pretty well. And then the ones that did the best were the ones I mentioned earlier, my VIX models that had a long volatility bias, right? So those are what kind of saved me last year. And I had the one that really struggled for me last year was the one that trades treasuries, right? So that's no big surprise. It's long only, and it just switches from one duration to another. So we'll go long duration, short duration, and it rotates that way. And every duration got killed last year. So that hurt. And then this year's been a real strong year so far. The long volatility model has flattened out. So I haven't lost money on that. I haven't made much with it. But the other models have done quite well as either, my trend model has done well, and my swing trading models have also done well. And a couple of them did well last year. But overall, my curves these days are a lot smoother than they were, say, in 2008, 2009, even 2011 and 12 and 13, because I've got so much more uncorrelated going for me now than I did then. I'm not depending on one model to be, hey, this is the way I'm going to trade now. I've got many different ways to trade now.
Oh, great. Anything that you're kind of working on now that you're excited about?
No, the VIX stuff is really the stuff that I'm most excited about. It's not just long vol. I trade the curve. So the VIX futures curve, when it moves into, I don't want to get too technical here, but sometimes it's upsloping, sometimes it's downsloping. And shifts in that curve are tradable beyond just saying, hey, we're going to get a spike in the VIX, or we're going to have the VIX go down. When we get the spike, rather than saying, hey, it's going to go down, I can say, hey, 5-month VIX future is lower than the 4-month VIX future. And I think at some point over the next few months, volatility is going to revert or expectations will revert to the point where the future is more uncertain than closer in the present, right? And that's generally, when you look at the VIX futures curve, the farther out you look, the higher the price of the VIX future is. And that's because 6 months from now, things are more uncertain than they are now. It inverts when something big happens, like Russia invades Ukraine. You see the VIX futures curve invert because there's all of a sudden lots of uncertainty in the market, and people think, well, things will likely calm down 6 months from now more than they are now. And so that's where you get that kind of unusual action. So I like trading the curve, the shape of it, as much as trading, up and down. It's not always a directional move that I'm trading these days.
Well, Rob, I want to thank you for coming on Chat with Traders.
Sure. The one thing that I would suggest also for people, if they're reading books, start with real simple quant books. How Markets Really Work by Larry Connors is a great one. And Brett Steenbarger, Daily Trading Coach, is another good one. Those are old, but goodies.
Great. Thanks for the tips.
Thanks so much for having me, Ian. I really enjoyed getting to talk to you.
Yeah. How can our listeners get in touch with you?
quantifiableedges.com. So you can email me at support@quantifiableedges.com, or just go on the website. You can check out some of the work I've done there. You can also get me at Capital Advisors 360. That's the firm I work with as a registered investment advisor.
Great. Fantastic. All right. Thank you.
All right. Thank you very much.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Having the ability to take care of my family, having the ability to help my communities, The markets also have pushed me to become a better version of myself.
Every day is unique and provides unique challenges and unique opportunities. I also continue to be challenged and develop on a psychological basis, which allows me to be basically the best that I can be.
Every day you need to be on your toes, because every day is a brand new day with new challenges that we'll face. Also the emotional aspect of the game. You have to work so much on yourself in the long run. I'm pretty sure I'll be a better person.
What I've found along the way and what keeps me in it really is the challenge. It's the hardest thing I've ever tried to do, and I'm completely addicted to the challenge.
What other profession can you look at where you specialize in and only have to work 1 to 3 hours each day, and creates that ability for more time and room for hobbies, time spent with friends and family, and other business ventures? So that's my answer. Just the ultimate and absolute freedom in your life.
Doing it to be financially free and break out of this Babylonian debt slavery system that we're in, which is worthless fiat currency, and make a positive contribution to society in some meaningful way. I love it. I dream about it. Perhaps it's an addiction. I love to be proven right. I need to be proven right. I hate being wrong. It's my retirement and my second career.
What keeps me in the trading game is my passion that keeps growing, and the fact that I'm getting better at it every day.
It has to be the money. It's the reason why all of us are doing this. And further, I have to say the freedom to do what you want whilst making money, and the learning, the constant improvement. You just have to keep improving. You have to keep learning and being better than the person you were the previous day.
The allure of one day being financially free.
It's all about money. Other motives to keep trading are freedom and a certain lifestyle. I also think that trading helps me improve myself. It can be humbling. I think it makes me a more disciplined person, but the main motive is money.
It's the challenge of the person you have to become to gain the success you want. You have to be humble enough to change your perception of things. Nobody's born perfect, but we do have the ability to change. That's why I like to trade, to reflect myself in the market.
What keeps me in the game of trading is the fact that with financial markets, every day is a brand new day, filled with tons of opportunities where you, and only you, are responsible for making the best out of those opportunities.
What keeps me in the trading game is easy and simple to explain. It's money.
Passion, intellectual stimulation and challenge. Every single day I learn and improve. No matter how good I think I can get, every single day I can learn something new. And lastly, freedom. I can trade whenever I want, from any geographical location I want.
What keeps you in the game of trading? No cap on how far you can go. Right? Sky's the limit. No office politics messing up your game. I've been there, and I'm telling you, that makes a lot of difference in your life, in the quality of life you have. The freedom that you have, for sure, the market's gonna land you a few punches on your face, but yeah, that's part of the game.
Nice question. It's so valid today, because trading really goes against all of my human nature, all of the way I handle life. But yet, I still consider it to be worthwhile the time and effort. I have not had a consistent profitability for 5 years now. The worst is I do it for fun, but I can openly admit that to myself. The best reason is I do it for really independence, to free myself from being dependent on anyone. And that's really all there is to it.
The hope for a better future, I think that is why most people are doing this. If it's for fun or as a hobby, it's not going to work out. Fortunately, it is something that I've learned to take very seriously and have had to learn the hard way that this is a long journey and it can be very frustrating at times. Some days I do want to give up, but changing the mentality from short-term benefit to what you actually want your life to be like, I think is huge, and how you can use what you're doing to help other people.
It's this great competition against yourself. It's challenging to look at yourself, the reward for it. You know, it's as pure as it gets. If you master yourself, and that can mean a multitude of things to different people. because there are all these edges in the market that make sense depending on who you are. You don't get that in other places, you know?
What keeps me in the game of trading is this daily fight with me, not with the markets, with my mindset, with my conscience, with my psycho trading that I have to always be aware, and knowing my role in this business. And my role in this business is just to follow the money.
Currently, I'm slightly at break-even point, not profitable, not losing that much, improved a lot. As I am getting improved, I feel that trading is getting boring, and I feel that once it felt like very, very boring to do trading, then it would be profitable. Yeah, that's all I want to share.
When I was younger, I was never really sure what I wanted to do with my life, both in school and professionally. My dad always said that one day the light bulb would just go on. I'm now 36 years old. I discovered trading in late 2019. And since then, I've just never looked back. I spent every waking hour looking at charts. It's just my passion and my calling, and eventually the light bulb did go on, and things will never be the same.
For me, it's the constant challenge of becoming a better version of myself today than I was yesterday. And I've not been a stranger to failures in my life, so I had the discipline to look back, review, and then to improve on my system by tightening my risk and my whole risk management system. And then having a positive feedback from it is what kept me in the game. And of course, the money. Yes, completely, totally, 100% the money.
I don't want to be dependent on what few people on the other side of the planet decide that we're just going to. Independency to me is the biggest motivator. You having 100% control over your own faith, over your own life. With trading, you can have unlimited potential, unlimited profits. There's no sky is the limit, literally. Now, that's beautiful. That's amazing.
The grind. It's the grind that keeps me in the game. The love of the grind. Because the grind is exactly the characteristic you need to survive the markets for years and years. Please understand it. It is the grind that makes us traders.
A losing trade, I already know this, could be the best trade, and a winning trade can be the worst trade, the exact same as gambling. The best bet I ever placed actually lost in the whole history of my last 12 years. It all came down to expected value of that particular bet, and the same thing applies to trading. The ability to actually get on and get set is much better than that of the gambling industry, where the bookmakers restrict you in Australia. So it's actually hard to even place the bets here, extremely hard. But with trading and all the different markets and various markets, the more I turn over, the better. That's the reason I'm sticking to it, and I absolutely love this podcast you guys do, and I appreciate it. Thanks.
Markets, speculation, and risk. This is the Chat with Traders podcast.
You're listening to the one and only Chat with Traders podcast, and this is episode 270. I'm Tessa Dow, and Ian Cox is with me here today. We're the hosts of the Chat with Traders podcast. Every once in a while, we like to do something a little different and take a break from our regular programming. And this is that episode. So what keeps you in the game of trading? What you just heard earlier was a compilation of our listeners' voices from across the globe. Thank you, listeners and traders, for sharing your voices. This is as real as it gets. In fact, many of the voices you just heard are also our members of the Chat with Traders community that I have had the privilege to meet and get to know. We wanted to share these voices with you because we know that you can hear yourselves also in these voices and what they have to say. So, Ian, I'm so glad you're here with me. In the present and last couple of years, it has been one of the toughest markets to trade in. Don't you think, Ian?
Yeah, definitely 2022 was pretty choppy. 2023, it's not, we haven't experienced a typical bear market, as you'd say, of steady, continuous declines in a trend. And so it's definitely been choppier than usual.
And I guess it depends on what side of the market you're on. And for some, it doesn't matter. especially for some, if you're trading options, you can benefit in any market direction. But in general, from your perspective, what do you think makes it so hard about this market?
Well, we've been accustomed to nice trending markets, right? From the bottom of 2020, the COVID low, up to, the end of 2021, thereabouts. Very strong trending markets, lots of liquidity coming in, lots of action in a variety of stocks, especially the meme stocks, penny stocks, and what have you. In the past, often we've had nice trending markets, whether they're up or whether they're down. And this is one of the different markets that, despite the rising interest rates, we'd have a sharp rally. So that part is different. And I don't know, maybe part of that is due to all the money that's been created over the last few years. I don't know if that's distorting the markets, but it doesn't seem as clean and consistent as some of the bull and bear markets of the past.
Has it been personally challenging for you in your own trading and investing as well?
Yeah, it has. I'm a trend trader, and in the past I got trained, you could say, by these strong trending markets where I take a position and then hold on to it for a while.
Ian, so you've interviewed at least a couple dozens of guests now. What are some of the things that you have learned and observed that set them apart from many traders out there?
Yeah. So, for example, recently I interviewed Dan McDermott, and I was impressed by how he phrased this. He says, with every chart that he looks at, he asks the question, what is a bull thinking with this chart? And what is a bear thinking with every chart? So he tries to take the side of both bullish and bearish sides to see how they think. And then he chooses the bull side or the bear side, depending on what's going on with the market direction. And that way he doesn't get married to a particular ideology, whether it's bullish or bearish, which is so easy to do. And also I liked what he had to say about the relationship between different time frames, looking at whether it's a 1 minute chart, 5 minute, 30-minute, hour, daily, weekly, and see how they correlate with each other to get a comprehensive viewpoint. Correlations between different asset classes, like he looks at the dollar and its impact on gold and influence on market trends using different time frames, that kind of thing. Also, correlations are real important within the same sector, just looking for different pieces of the puzzle. And lastly, with Dan, I enjoyed what he had to say about be consciously aware of the conversations going on in your head, because psychology is such an important part of the process. And this awareness of what his mind is going through, either being ecstatically bullish or being fearfully bearish, this awareness helps him avoid being ruled by his emotional extremes.
Yeah, so you were referring to episode 267, just to bring that up in case any of our listeners want to go back and listen to that episode. Any other episodes stood out for you that you felt had an impact on even your trading as well? So
one guest who I interviewed, who I was really moved by his determination and passion, was Patrick Peterson, a trader from Germany, in episode 260. So I was really impressed by his determination to self-study about the stock market as a teenager. And he was so excited that for his birthday, on his 18th birthday, he ran down and opened up a trading account. And he was so determined to make it work. And this is in a country, mind you, where the culture and his family did not approve of trading for a living. Sure, they are into investing, long-term investing, but trading is almost incompatible with their culture because they're much more conservative than what we frequently find here in the U.S. He was so determined. Yeah, back then. I mean, this is 20 years ago, admittedly. So back then, he was so determined to make it work that he ignored his family and cultural attitudes against traders. And he blew up many accounts, and he actually endured months of homelessness, sleeping in his car, because his family would say, hey, that's your tough luck. It's your problem. And so they didn't show any love and support for him. And so, but he still had the fortitude to approach wealthy bankers and say, hey, look, here's what I'm doing with trading. And he had the confidence to get back up and say, here's what I'm doing, being very transparent on how he trades. He says, ask them, can I manage your money for you? Mm-hmm. And he was convincing enough to get them to agree so he can manage their money. And they're used to getting quarterly reports like most of us are, right? What did you do for the last 3 months? But he wanted to be different than all the rest. And so he gave them daily reports. And this transparency helped attract other investors. And so then he was able to sell himself and prove that he could deliver to them. And that was quite moving. I found I really enjoyed that interview. So he's a very much of a feeler. He feels his way into the market and considers himself an intuitive trader.
Don't forget that he breathes in and out the markets, right?
Yes.
That is what he's known for in this episode as well. Amazing episode. Yeah.
Right. Yeah. He said, I must become the feeling of the market.
Mm-hmm. Something like that.
Yeah, exactly.
So, what other topics, like trading themes that you can recall in some of the episodes that really stood out to you?
Vincent Bruzzese, in episode 255, his knowledge of statistics, actually he was a statistics professor, and a long-term poker player, how he used these statistics to in his quest to find, can I beat the market? Is there a statistical edge that I can get to give me that edge so that I can get the edge over, say, just buying the S&P 500? He got into the market long after he had a well-established career, and it was his quest to investigate whether this was possible. So he focused in on mindset, right? And he found that to be the most important aspect for him, because being a poker player, which he nearly did this professionally, that he found that, mindset is so critically important, knowing when to walk away from your losses, when to add and when to fold. And so he looked for certain setups which put the odds in his favor. And he was patient enough to wait for those setups. So, for example, a setup might include stocks with strong relative strength in conjunction with market or sector direction. Breaking out of these compression zones was key to help him wait until the right times, wait until he gets that good hand, so to speak, like what he was used to in the casinos, and then add a sizable position and trade, wait for the trade to unfold.
Something I remember about this episode that stood out to me is his approach to trading everything in context. Contextual trading. Do you remember that conversation?
Yes. Yeah, exactly. In other words, he would look at many different factors that would be going into, why is a stock moving up or down? And it's an accumulation. It's a kind of a mishmash of all these different factors, which will help him give context to, it looked bullish before, but now it's not quite so bullish because of these additional factors that are coming in. So he's juggling different factors as are going on in the markets, both technical and some fundamental as well, to color his, to give a different flavor of how he should go long or short these stocks.
Prior to this, he worked in the movie industry.
Yeah, that too.
That stood out to me.
That too,
to go from Hollywood to trading is just completely different.
Yeah, exactly. So he had a well-established career and he was making plenty of money. He didn't need to get into trading, but it was his curiosity if he could beat the game, so to speak. And he has a very giving back attitude, and he created a site called Real Day Trading, which is free of charge. You can see exactly what he trades. He posts all his trades live when he goes long, goes short, and when he exits the trades. So that is nice to see that he's wants to give back to fellow traders, and he's very upfront and says, look, this can take years of education and it's not an easy path. But his wiki that he has is very packed, densely packed full of great information, helpful advice on how to start the journey of trading full time.
Yeah, it's amazing. Any other topics or episodes that stood out to you?
Well, every episode stands out in its own way. Some are more moving than others, obviously. One interview that I did with a guy named Christian Carrion in episode 254, I was really moved by his story of growing up in a financially illiterate family. They came here from Mexico when he was quite young. His sister had issues with her kidney, I believe it was. And then he got kidney disease as well. So from a very young age, he was hampered by his freedom to, learn and do all the activities that normal kids do. And it was out of the 2008 financial crisis where his mother's business went down the drain and there was problems with alcoholism. And he said to himself, I have to learn ways to develop a passive income because I'm stuck here at home. I've got this machine that's trying to clean my kidneys and I can't get a normal job. So out of sheer necessity, he found out about the markets and he became obsessed with it out of necessity and passion as well. And then he developed a trading system. He convinced wealthy people, so that he could manage their money. And he's done quite well for himself in trading the S&P through this compression zone system that he's got. And he actively shares his views on Twitter. So I felt really connected to him.
I remember, right around the time, actually during this interview, he was waiting for a kidney transplant.
Mm-hmm.
Remember that?
Yeah, right. He was like stage 5 kidney disease.
Yeah. And then right after, I think shortly after we recorded the interview, he had found a kidney transplant, which was so amazing, just the timing and everything. We were so relieved to hear that.
Yeah.
Yeah, and I last caught up with Christian not too long ago, maybe a month ago or so on Twitter, and he's doing well.
Mm-hmm.
He's doing well and, trading and just taking it one day at a time.
Yeah, great.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital. the three episodes, the three guests that we had on the show, they actually are, well, Patrick is part of the Chat with Traders community. He's one of the hosts. But Vincent Brusisi came back into the community and, gave a couple of presentations and updates on, how things are going since the episode 255 with him. I thought that was cool that we got to know him more and his strategy and thought process even more. So I thought that was really cool that he came back to give us more information. And then also Christian Karian also came back into the community and provided more insight into his strategy.
Yes. Yes. Well, what was helpful about their presentations within the community, being that it was video, is that we got a chance to see exactly what they're talking about, the exact setup. What does a chart look like when they take a position long or short? How do these compression zones look like? That was definitely helpful.
Any other episodes that you just can't help but, smile, make you smile?
I found I really enjoyed talking with David Capablanca. He has from the Friendly Bear, and he calls his site that because he focuses exclusively on short selling. And he got into the business of identifying essentially scams. Scams really annoyed him because of, the very nature, trying to fleece money out of people. And so he would sign up for these message alerts from these companies, penny stocks, essentially, companies. And he would get an alert every time they come out with a news story designed to pump up their stock so that the insiders could dump their stock on unsuspecting traders. He would follow this so that he would was able to time the shorts to an area of maximum liquidity. And given his study of the charts in the past and the companies in the past, that he was able to time this quite well and make a living exclusively shorting penny stocks. One story that he shared with us is he was following the cannabis sector quite closely back during their run-up. And he actually went down to Colombia to visit a site that supposedly this company was growing its marijuana. And this company is publicly traded on the U.S. exchanges, but they have this place down way out in the outskirts in the country in Colombia. And he'd go there, and the security guard wasn't expecting them there. And it was, he got nervous and called the CEO. And so David had a chance to briefly talk to the CEO on the phone, who was obviously trying to hide something from him. And it was a total scam. The site, there was nothing there. It was just a front. And so David would end up shorting this stock just as they're trying to do a secondary offering. So they pump up the stock, and David would short it, and with great success. So I found that the adventure, the traveling trader, enjoyed his stories.
I really enjoyed that episode as well. I mean, I can't help but feel like I was watching a movie. An action movie or something. Doesn't it feel that way?
Yeah, exactly. I also found it interesting how he focused in on sympathy plays to the meme stocks. So stocks which had this huge run up, like a GameStop or an AMC, but he felt were less risky than the meme stocks, and that he would jump on these sympathy plays because investors were looking for the next greatest thing right after GameStop and AMC. So he would short the sympathy plays. So I found that episode 257 quite entertaining.
Yeah, me too. That was a very fun episode to listen to. What about Jack Kellogg?
Oh, yeah. Jack Kellogg, the episode 249, the penny stock specialist is how I call him. He concentrated in this area because of what he says are cleaner chart patterns that are easier to read because the institutions aren't really involved in penny stocks. And so he felt it was less interference and less noise that you normally get in a stock that's traded by algos and institutions. So he concentrated in this area and would follow the liquidity flows into and out of the stocks and ride the wave up and the wave down. And he became incredibly successful, turning $20,000, I think is what he started off with, and turned it into over 6 million in, I believe it was 6 years. His performance is impressive, very impressive. And I felt moved by his gift to his parents on Jack's birthday, going to the bank and pulling out $100,000 in cash and giving his mom, I think it was 50 and his father 50, something like that. And it was kind of heartfelt to see this sense of gratitude to his parents, who were not rich at all. They were just regular working class people, as a way to say thank you. Thank you for being such great parents to me and being so supportive.
Yeah, I remember that episode very well. And Jack's candid way of speaking with us.
Yes.
Basically, he just felt like the guy next door.
Mm-hmm. Actually, that reminds me. I did an interview with Lucas Froelich, episode 259. I was moved by his ability to capitalize on that very rare circumstance, right coming out of COVID, where all this liquidity gets injected into the markets, and many companies feeling like this is their last time to do a secondary offering, because they were thinking that the market's going to continue to go down, and this is their last hurrah to raise money. And so Lucas would focus in on these companies with very weak balance sheets, poor history. These are penny stocks, mind you, mostly penny stocks. He would study their patterns to see what they did in the past, how much money was being raised, what the secondary offering price was. And he would time his shorts with amazing precision and would add to the shorts as it was going down. So he would lever up his position, adding more and more and more as the stocks collapsed due to offering so many additional shares. And he made absolutely mind-boggling returns in the many, many thousands of percent. Saw an audited report done by this accounting firm. You can listen to that in episode 259.
Who can forget that one, right?
Oh God, yeah.
Yeah,
Exactly.
amazing. Any other episodes that do you want to mention?
God, there are so many of them. One other one that comes to mind is the idea when we talk about being a contrarian investor. We've heard that term, but is it simply enough to say, well, I'm a contrarian investor. If people are bullish, I'm going to be bearish. But, going that route, that simple route, can end up, you can lose a lot of money. Well, one trader who is actually in one of the Market Wizards books, his name is Jason Shapiro, in episode 245. He takes the approach. So he takes a very contrarian approach where he looks at the Commitment of Traders report that comes out every week. And he sees the level of institutional longs and shorts, as well as, small traders, longs and shorts. And he times his position such that he waits for extreme sentiment readings, extremely bullish or extremely bearish, in, say, the indices, like, say, S&P 500, or it could be oil or gold or whatever. And he takes, if everybody is super bullish and there's a news failure day, meaning that an important news comes out that is bullish, for example, and the market ends up, say, going down on that day or fails to go up. He looks at that and says, okay, this is a very important news failure, meaning it should have gone up on this bullish news, but yet it actually went down. And so then he ends up going short that which everyone else is long, because when you've run out of buyers, well, then in his view, you have nowhere else to go but down. And he's made a very good living doing that for decades now. So that was an interesting approach to be contrarian.
Yeah, I remember that was actually your very first episode, Ian.
Yeah, that was. It was my first interview. Yeah.
Well, thanks, Ian, for sharing some of your thoughts on these trading themes and episodes that really stood out to you in the last 14 months or so. There's so many great episodes, and there's something for everybody. And some of the ones that that you didn't mention, but I thought stood out to me also were the ones that are related to risk management and trading psychology. The risk management one I remember in episode with Alexander Moreno. Remember that one, Ian?
Oh yeah,
episode 258,
where
he had losses and he was homeless at some point, and he came clean. And what helped me in that episode was how he shared the different kinds of losses. I don't know if you recall at the top of your head, but there were different categories of losses that you should be able to, distinguish, like an acceptable loss versus a dumb loss or something like that.
Was the acceptable losses that was connected to if you follow your system and you end up taking a loss, well, then that's a normal loss. That's acceptable because you followed your own rules.
Yeah, I believe that's right. But it really just kind of helped you to see losses in a different way and how to handle losses in a more intentional way, I thought. And it's a huge part of risk management. Alexander focuses on risk control, risk management.
Yes.
Another episode was a recent one I did with Mark Bunnell, treating trading as a business. I thought that episode was really impactful, and I think it's impactful to a lot of traders as well, because a lot of times we don't think of it that way, trading as a business. So there's just so many great golden nuggets in there, very in-depth, and I think if people want to really take trading seriously, should consider listening to that episode again. And that was episode 266.
266, great.
One more category that's important to me is trading psychology. So Ivan Bayaji is another good one. Episode 252, where he's the trading composure guy. Everyone, a lot of people know him on Twitter. I thought that episode was quite like a different take on trading psychology and how to handle uncertainty in the markets. Also, there were some great all-time past favorites. These are the older episodes with Brett Steenberger and Lance Brettstein. Again, there's so many great episodes, and there's something for everybody.
Yeah, exactly. For me, it feels almost like a big trading family, and each family member has something very important to share, and we can learn nuggets from everyone and in our journey. So it's great that we get a chance to dive into their world and learn something from them.
Ian, so from my observations on what most all of our guests have in common, I see a common thread. And some of the things I've noted were that they've honed their own strategy. They've ended up going with a strategy that worked for them and not really copy anyone. At least I don't think, from what I heard. Like, they had really unique strategies.
Yeah, their strategies often was derived and created through the troublesome times that they had. Some of it fits their personality. So oftentimes strategies is to choose from are the ones that fit you personally. Some people can feel the market, like Patrick. Others say, no, I got to have my process, my statistics behind me. And they take a different approach. But yet trading is a very personal journey. And you need to find that system, that methodology, you could say, that fits you personally, while also everybody's got to be aware of and develop their own risk management system. The why is so important in trading. All these guests had a very strong why. Why do they want to be in the market? What's the driving force to keep them in the game, to keep them pursuing that? They're pursuing their goals of finding out what did they do wrong and how are they going to fix it? How am I going to fix my bad trading issues? What do I need to manage? And so this fiery determination is a key factor, I believe, in keeping you in the game when things are going against you.
Yeah, I'm so glad you brought up the why, right? I mean, I observed that the successful traders, they were either very good at, figuring out their process or their one thing, or they're, very passionate about trading, or maybe it's a combination of these things. But you're right. I think it's important to have passion too, and the why, knowing why you're doing things, because it's the why that helps you to get back up, to pick yourself back up when things are really getting tough, right?
Exactly.
Now, whether it's necessary to have passion in trading to do well is a different story, and maybe a different episode. But I really think the passion helps too. But the why is so important, like you mentioned.
Yeah, exactly. And I want to actually thank our listeners for suggesting certain candidates to be interviewed, which we would have never known about them had we not had such a close community to suggest, hey, have you heard about this trader? Have you heard about that trader, for us to interview? And we've got some great guests on there that I didn't know about and Tessa didn't know about. But thanks to our listeners who wanted to support the community, they suggested certain traders, and we thank you very much for that.
Absolutely. So yeah, I'd like to add on to that. If you know of any talented traders or, traders that you feel like we need to get on the show for us to, look into, feel free to get on our website, chatwithtraders.com, and then click on the Speak to Chat with Traders. You can record your voice or send an email to hello@chatwithtraders.com and provide us your recommendation and any other information that you might have. Of course, we have our own review process, and then that's a normal part of what we do. But we would love to hear from you if you have any great suggestions. Oh, and continuing on to the common thread, another thing I noticed too is that with all these traders is that they all went through a lot of pain and a lot of losses. And I think people just don't realize that, success didn't just happen.
Exactly.
Like recently, right?
Mm-hmm.
What are your thoughts on that, Ian?
Yeah, well, their determination allowed them to plow through their multiple blowups of their accounts and say, I will not stop. I will not stop until I become successful at this. And they had to constantly innovate, relearn, get these lessons drilled into them. And they self-studied as well. I mean, they're seeking out advice from other traders, reading lots and lots of books. This determination is the drive that keeps them going.
So what I noticed is that they didn't give up when things were getting tough, and they found a way to pick themselves back up and bounce back. So that's what keeps them going after having gone through the tough times. They didn't give up. They believed in themselves. From my observation, I'm guessing that I would say that this is probably why these traders are in the top 1% to 5% of traders that make it.
One important factor that's been mentioned in the previous podcast is that when one takes losses is to shrink the size of their trades, get it down, but to keep mentally in the game. You got to keep in the game. You got to have some skin in the game so you keep some interest. So there's debate on whether paper trading is really that effective because emotionally you're not in the game. But after having big losses, to keep trading, but make the trading size super small so that you can build yourself back up mentally. Because it's a mental game, and it's can be devastating to have large losses, and you feel like, oh, I just want to quit. And it's a natural thing to want to do, and say, oh, maybe I'm not cut out for this. Fail often is a common word that's used. Yeah, the more you fail, the closer you are to success.
Yeah, I mean, people where they have the most growth is that they learn from their mistakes and their failure more than they do. Yes, you can still learn from your successes, but the most impact, I believe, happens when you're able to learn from your mistakes and your failures and your losses, and then intentionally apply what you learned and practice and get better at it.
Yeah, exactly.
Another thing that I noticed, a common thread, is that they're all hardworking. They're all willing to put in the work. They put in so much of their blood, sweat, and tears in this. I mean, you can't just manifest. You can't just, think positively. You actually have to put the work behind that.
Yeah, certainly. And for some traders, is their attitude is, I cannot get a regular job. It would. So not only are they motivated on the positive side by having rewards from trading, hopefully in the near future, but they're also motivated to avoid a regular job that most people work because they find it so distasteful that the combination of avoiding the distasteful aspects of a regular job and the rewarding aspects of a profitable trading account make it kind of an unbeatable combination to say, like burning the boats. I will not go back to my regular job or jobs which I hated in the past. I will make trading work. There's no ifs, ands, or buts about it.
Yeah, I can see your perspective on that, Ian. But however, I think there's no shame in keeping your full-time job or your part-time job or whatever, or a business that you're running until you feel you're ready, until you can prove that you can make money part-time, trading part-time. Because how I see it is that if you cannot prove to yourself you can make even just a little bit of money consistently doing it part-time, how can you make money trading full-time?
Well, that is a good point, right? And some traders we've had on have said that them being supported by their family or having a full-time job allowed them the discretion to take on more risk and knowing that they had something secure to come back to. Whereas if they had no job and they were relying only on trading income from the get-go, that it would make them too scared or too nervous. They would get spooked by their own psychology, so to speak. And then that could lead to taking reckless trades because they got to make the rent that month, right? So it's a very individual journey. From my point of view, I certainly agree for myself to have a regular job on the side and then have trading income to supplement that so that you're not dependent. You're not trading because you have this deadline of money that you have to raise for just to live, but that you are trading for future profits and that you can have the discretion of not taking positions if you don't need to or don't want to.
Yeah, good point there. I guess, it also depends on your tolerance level for pressure.
Exactly.
I want to get your thoughts on this, Ian. How we mentioned risk management and all that is important. But what do you think of people who, or traders who are trying to, get better? What if they have too much risk management and they're not taking enough risks? That could be a challenge as well.
Yeah. Okay. So not being able or willing to take sufficient position size, again, could be a sign that they don't have total confidence in their system, or they haven't really flushed out their system yet. And so hence position sizing is not only important to avoid losses, but it's to take advantage of the good opportunities when presented. And so having a system where you get lots of chart time in, you know what you want to see in the charts, but having the patience to wait until you see those great setups and all that training that you went through all those months prior. And then when you see the setup that rings that bell, that then you say, it's here. Now I have the confidence to go in with bigger position sizing than I had in the past because I didn't see that great setup. This is really important to get that screen time in so that you train yourself over time to see those opportunities, which may be rare depending on what you're looking at, depending on the system that you created, right?
Yep, that's part of putting in the work. And you mentioned the word patience, and patience is so important too. I feel like that sets the successful traders apart. And I'm not just referring to patience in the actual trading while you're trading, but in general, patience in a trader's trading journey. Because it's hard to have patience these days when everything is just all about instant gratification, and getting results instantly.
Yeah, this also applies to regrets on missing out. FOMO, fear of missing out on all these different stocks that make these big moves. And then you say to yourself, I should have seen that. I should have seen that. Well, not necessarily, because you're focusing on a particular setup that you're honing your skills on. And you're going to miss a lot of opportunities. It's just that the vast majority of these pumps you may miss, but you're setting yourself up for the opportunities in a system that you're focusing on, you're creating, so that you're ready when these moves happen. And you don't have to make that many profitable trades at the right time to do quite well in the market. You just have to be disciplined to follow the strategy that you developed and don't worry too much about the ones that you've missed.
Great. And what do you think of mentorship? I believe that almost every guest that you've interviewed had some form of mentorship, whether it's casual or, like a professional setting mentorship. But I believe that played a big role in taking their trading to the next level too. What are your thoughts on that?
Yeah, the mentorship so that they could get guidance through their journey and get an outside perspective on what's going on at whatever stocks that they're looking at, right? They think, oh, I should go long here, I should go short. Well, the mentor can come in as a neutral player and point out things that the trader misses because they get swept up in the emotion of the moment. And it's fine to learn all these things. And intellectually, you can say, oh, yeah, I've learned this and that. And I agree with all these things I've learned. But when you're placed in the heat of the moment and your emotions take control because some stock's making a big move, either with you in it or you not in it, the mentor can keep you balanced to help you have a clear head, give you a bigger picture. So yeah, mentorship can be very important.
Yeah. As you can see, all these traders that have been on Chat with Traders have different trading styles and strategies and, trading different markets, but they all have these things that we just mentioned in common, mostly. Were there any other common themes that you noticed, Ian, that we haven't mentioned?
Common themes, well, blowing up your account at least once or twice seems to be often a rite of passage for most traders, right? Because they there's nothing like learning a subject when it's burned into you emotionally. Intellectual learning often is insufficient.
Right. That's so true. You gotta not be afraid to put yourself out there and do the work and to fail, expect to fail. So in a nutshell, I feel like what I was trying to get at is that even though these traders have maybe different trading styles and strategies, trading different markets, but what brings them all together that we can learn from and improve on is the trading mindset. I think that plays a huge role, believing in oneself to be able to do that, having the discipline, the self-discipline to improve your behaviors and habits and to be consistent in that.
Yeah, don't forget about accountability, right?
Accountability is a big part too.
Exactly. So often traders, when they make trades and if they lose money, they don't have to tell anybody about it, right? And so they can end up deluding themselves to a certain extent because they're not holding themselves accountable by having, say, an accountability partner to help them through this journey.
Yeah, good point, Ian. And but guess what? Something that I think that is not talked about as much is that they were not all necessarily balanced in their life. Some of them suffered physical pain. I remember Jack Kellogg talking about his he went through a lot of physical pain, or their health declined in some way to some degree. But does that mean that the rest of us will have to go through this as well? I mean, I personally don't think so, because we can learn from the challenges that these talented traders faced and do something about it. So this reminds me of episode 256 with our special guest, remember Luisa Nicola, on supercharging the brain and body with peak performance habits. I honestly think that some of us avoid listening to this because if we do, we know that we have to change our habits. But exactly. I feel like it's worth listening to again.
Yeah. Habits are can be challenging to create and also to break the bad habits. So our brain is like a computer. The brain likes habits. It likes continuity and going to bed at the same time. It likes eating at the same time. So it's important that we take care of ourselves because some traders, like, for example, Jack Kellogg, shared with us how his health suffered, his body suffered, even though he's a young guy, by him not taking the time out to get outside, do some exercise. Because we have to keep this balance so that our mind stays sharp, and being too extreme, just staring at the screen all day, not moving, could impact in a negative way our performance long term. So it's a comprehensive approach involving mind, body, diet, exercise, that kind of thing, to
Yeah.
our trading at a top tip performance.
I know we can say this, Ian, but I just know that many traders are still gonna do what they're gonna do, right? But at least we did our part and share what we think is really important to stay healthy and balanced, so that you can stay long enough to last and still stay in the game of trading. Another thing I think that we don't mention it a lot is taking action. Taking action is really important. One of the things I have learned and observed, that if you hear something that clicks with you, whether you're listening to an episode or saw something on the internet, whether it's a strategy or an idea to test out, it's helpful to take notes and take action on it right away. At least that is for me, from my experience. I mean, I've heard a few things that resonated with me, and I took a mental note to check into it further. But, guess what? I never did. Then that's how you kind of end up being in this, forever learning cycle. I mean, It's great to learn, and but then you can be in the cycle and never get out of it. And that's when you start to feel stuck in your trading journey,
Right. It's important to write down, make reminders for yourself to actually implement some of the things that you learned. It's better to implement, one or two things that you learned than to learn 10, 20, 30 items and not actually implement them into your life, into your trading. And you say, well, I have all this knowledge. Well, no, but you got to practice it. It's got to be put into effect as a habit, because habits take time to create. And yet, once you've created them, they actually work in your benefit, in the sense that you don't have to expend the mental energy later to keep up with this positive habit.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest. Exactly. But to be fair, Ian, I mean, sometimes people want to take action, but they feel stuck in their trading journey, perhaps because they're overwhelmed because of maybe work overload, having multiple jobs, or analysis paralysis, or waiting things to, line up perfectly, or even just putting too much pressure on yourself, or not putting enough pressure on yourself. So then you feel guilty. But what I have to say to that is, taking some action is better than taking no action at all. And one of the things that I've learned in my own life on how to get unstuck, and I'm still trying to get better at this, is to try to take micro or tiny baby step action.
Exactly.
And an inspiring book that I've read recently is Atomic Habits by James Clear. And you mentioned that
yes,
a couple of times as well. What did you love about that book?
James Clear is all about, creating habits, kind of the 1% improvement per day type thing. So you take off little bite-sized pieces, write down the things that you need to do the next day, say the night before, prioritize them. Some people argue, get the easy ones done first when you start your day, so that you can have a sense of accomplishment, and that adds fuel for you to tackle the more difficult things later. Different viewpoints on that. Some say you should tackle the most difficult things first thing in the morning. But it's important to make an appointment with yourself, because your mind, you need to train your monkey mind. We all have this monkey mind, and the monkey mind will lead you astray, as it frequently does, unless we create positive habits, which could involve making appointments with yourself the night prior, scheduling things in your calendar so that you keep a hold of yourself, that you otherwise you can be led astray.
Ian, is that actually in the book, or is this from your own? A
lot of it's in
experience?
the book. It's a combination of different books that I've read on the subject. So it's like a kind of a mishmash of different things I've read on the subject over the years.
That's awesome. Yeah. So this is what I really believe in. It's okay to take imperfect micro action, as long as you're moving forward, as long as you're in the right direction, then you're making progress. So, as you can see, there is no right answer to the question that we posed at the beginning of the episode. What keeps you in the game of trading? You heard those voices. It's right for the person answering it. So the thing to be intentional about, though, is whatever it is that keeps you in the game of trading, you want to remind yourself of your big why for trading every single day. Maybe your why will change because it wasn't compelling enough for you to, fight hard enough to stay in the game. Then that's okay. And maybe it turns out that through this process, you're discovering that trading is not for you after all. So is it okay to quit trading? Well, I'm going to say something that is probably not very popular, but absolutely. Now, this may sound like I'm encouraging you to give up and quit trading, and that won't obviously help the listenership of the podcast. But I think it's more important to be straight up about this. I believe that it is okay to realize that trading is not for you, and there's no shame in that. As much as it takes courage to not give up, it also takes courage to know when to admit it's time to quit. Your thoughts on this, Ian?
I think of it more in terms of taking a break from trading rather than just completely stopping trading altogether. Adjust your position size, right? So if you're used to trading, say, with a, $10,000 lot, maybe you lower it to 1,000 or 500. My view is stay in the game, even if you have to make the trades really small for a while.
Yeah, and I'm not saying not to stay in the game. You want to do everything, absolutely everything you can to stay in the game. But at some point, because we kind of live in this culture where it's all about, oh yeah, you never quit, never quit, never quit. But sometimes it takes courage to quit and say, it takes courage to admit that this, for example, this path that you're going down is just not right for you. But only after you've done everything you can. That's what I'm trying to say.
Okay. Yeah, great. Thanks for sharing. Okay. I'm done.
No, you have to add more to that.
No, we rehashed it.
Okay.
Yeah. Okay.
So we're wrapping up now, and to circle back on what keeps you in the game of trading, if you feel compelled, get on our website, click on the Speak to Chat with Traders page, and record your voice. Let it out, say it out loud, and believe it. And hold on to that feeling and remember it when you're having self-doubt or you're feeling overwhelmed. You feel like you want to quit. Remind yourself of that why, what keeps you in the game of trading, and let it energize you again. Okay, well, Ian, I had so much fun doing this with you today.
Yeah, it was nice having a review, kind of reflect upon the different guests we've had and what we learned from them, and live vicariously through their journey, so that hopefully our trading, so that we learn not just intellectually, but emotionally as well.
Yes, we really enjoyed doing this. If you have any questions for Ian or myself, you can get on the Chat with Traders website and record your voice, or email us at hello@chatwithtraders.com. We're very accessible as well inside the Chat with Traders community. You can request complimentary access to the Chat with Traders community. You just have to go to the community page on our website and request access, and we hope to hear from you soon.
Great. Thanks, Tessa.
Thanks, Ian.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
You have to design what you do to suit your own financial puzzle and your own biases. As the great late Dr. Tharp used to say, you trade your beliefs, not the market. Sit down and write down your objectives, your financial puzzle. What are you trying to really accomplish with your trading? And design what you do to fit your lifestyle, fit your expertise levels, fit your portfolio size, then execute the darn thing flawlessly, and life would be good. You'd be a lot more Mr. Serenities out there floating around the trading world than there are these days.
Markets, speculation, and risk. This is the Chat with Traders podcast.
This is episode 271 on Chat with Traders. I'm Tessa, your co-host, and today we have the pleasure of speaking with a special guest. Experiencing the brutal market of 1973-74 impressed upon our guests the necessity to find ways to hedge risk. This began a multi-year-long quest to find the right combination of uncorrelated assets, technical indicators, and adjust the weightings as needed to provide enough protection to fill in the potholes of equity drawdowns while retaining the bulk of upside potential. Having a sweet balance between risk and reward, both in the financial markets and in his personal life, has enabled him to maintain a serene disposition. Who is this? His name is Tom Basso, who was on the show back in 2015 on episode 30 with Aaron Fifield. If you haven't listened to that episode or want to listen to it again, you are more than welcome because we know how beneficial it is to keep these episodes up because, of course, there's still so much value to be gained from them. Fast forward 8 years later, our host Ian Cox has the pleasure of speaking with Tom. There's still so much insight that we were able to extract from this very amazing veteran trader of the markets. Why? Because even though he's been there and done that and have been a big influence on the trading careers of many, he didn't stop learning, growing, and improving as a trader and investor. He kept going, as you'll learn. Tom is a retired money manager and futures currency trader, golfer, winemaker, author of The All-Weather Trader, and believer in behavior economics and more. Ladies and gentlemen, we are so pleased to present and welcome back the calm, cool, and collected